Hello everyone, I hope you're doing really well. In this session, we're going to be covering the amendments which are applicable to CA Inter Direct Tax Paper May 2025 exams. Like we know, May 2025, the Direct Tax Paper, Finance Act 2024 will apply. So all the amendments which are going to impact your syllabus, starting from the Basic Concepts chapter till the Assessment Procedures chapter, all of these chapters we will be discussing them in this session. It's going to be comprehensive, it's going to be extensive, I'm going to go in depth, and trust me when I say this, by the time we finish this session, your entire fear about the amendments would have disappeared. But before I start, let me spend a few minutes to sort of give you guidance, because there is a lot of miscommunication happening out there. Now, are there amendments? Yes, there are. Are they significant amendments? Yes, they are. But is it like your whole tax paper has changed altogether? No. But is it like, do I have to take classes all over again? Not really. See, I'll help you decide, do you need classes again or not? Please take a well-thought decision, because you're spending time and money unnecessarily if you make a wrong decision, right? See, if you belong to that category of students who have already completed the full course properly, you've done a good practice of questions, you've completed all the lectures already, and you just need to get updated because of the amendments, then in that case, you do not need the lectures all over again, guys. Just this amendments video should be more than sufficient for you. Alright, the second category of students are those who, because of some reason, let's say they subscribe to a full course, but they haven't watched the full course fully. Let's say you have only 10 to 15% knowledge. You couldn't complete the lectures because of, let's say, time constraint, or let's say you didn't plan better, or whatever reason it could be. You have only 10 to 15% knowledge. Then of course you can avail my full course. You will find it on my website, and I can give you an open challenge. You will not find a regular course of DT as extensive and as in-depth as mine. It has a very good combination of concept knowledge plus questions. Alright, but then if you belong to a category where you have knowledge and you just need practice from the exam point of view, then of course the most talked about, the super hit workout batch is back for the May 25 exams. We will be starting it in the month of March. The details are already available on the website. You can avail it. In the workout batch, it's nothing but a practice batch. Here 350 to 400 questions exactly from the exam point of view we work out. In these questions, whatever concepts are involved, we discuss the concepts also, and then we work out the questions. So obviously almost your entire syllabus gets revised, and that too from the exam point of view, and you don't have to work any questions after this. So this is your workout batch, your practice batch. And then comes the last category. Let's say you have issues only in one particular chapter. Let's say capital gains chapter alone you've not studied ever properly before. Then in that case, you can avail chapter wise lectures, which means that particular chapter alone you can avail from the full course. Instead of availing the full course, you can avail that particular chapter alone. And I know for a fact you might be thinking, ma'am, how will I do interlinking of provisions, and how will I interconnect provisions if I avail chapter wise? That you leave it on me, because we've been delivering chapter wise lectures for quite some time now, and I sort of know while recording itself that the same lectures will be going later as chapter wise. So when I'm recording the lectures, I take care of all the interlinking and interconnections at that point itself. So I think this will help you decide whether you need a lecture again or not. I mean, just because there are amendments, don't blindly fall in the trap of new lectures. Alright, if you've already done the full course properly, then this amendments video is sufficient. Alright, so anyways, coming back to our amendments discussion, the main focus of this session. Let's start with our basic concepts chapter. This PDF which you are seeing me use over here, I will share this in my Telegram channel. The link to my Telegram channel you will find in the description box below. What I've done is, in this PDF, I've brought both the old provision as well as the new provision. The reason is most of the provisions are applicable from, let's say, 23rd July 2024 onwards, or 1st October to 2024 onwards, or 1st January 2025 onwards. So therefore there are multiple concepts where you need to know the old provision and the new provision. So for all of these concepts I brought both the old and the new so that you can have a good comparison and your learning and understanding will be a little better. Now let's straight away dive into the amendments. Let's start off with the basic concepts. Now here there are only two amendments, simple amendments. See, we know very well if assessee happens to be an individual HUF, AOP, BOY or AJP, those assessees have two options, guys. They can either follow the default regime, that is they can follow section 115 BAC, or they can compute tax as per the normal regime, which is also called as the optional regime. So assessees have two options. If by default they will fall under 115 BAC. If they opt out of 115 BAC, then they can follow the normal regime. Now in normal regime, slab rates, there is no change. Normal regime rebate, there is no change. Normal regime surcharge, there is no change. In the tax computation, there is no change in the normal regime. Here, even now, if assessee is generally the basic exemption limit is 2,50,000. If assessee is a senior citizen, then 3 lakh. If assessee is a super senior citizen, then 5 lakhs. So in normal regime, there is absolutely no change in the tax rates. But the change is in the default regime. Even in default regime, if you see, there is no change in the rebate under 87A. There is no change in surcharge also. Where is the change? The change is only in the slab rate. You got the basic point first of all. So what is the amendment we're talking about right now? We're talking about section 115 BAC. There is no change in the normal regime. There is a change in the slab rates of 115 BAC. Even now rebate is the same, surcharge is the same, only the tax rate, the basic tax calculation, the slabs have changed only in 115 BAC. Even now 115 BAC is not applicable to everybody. It is applicable only to individual HUF, AOP, BOI, AJP. Even now in 115 BAC, the basic exemption limit is 3 lakhs. Okay. Even now if you see, the maximum tax rate is 30% only. Only the slabs in between have changed. Here what I've done is, I've brought both the existing provision and the amended provision. You can learn straight away the amended provision alone for this year. Now, if the income is up to 3 lakh, no tax. So 3 lakh becomes our basic exemption limit. Then where is the change? The first change is over here in the second slab. Income more than 3 lakh but up to 7 lakh, 5% tax. Income more than 7 lakh up to 10 lakh, you will have 10% tax. Income more than 10 lakh up to 12 lakh, 15% tax. The last two slabs remain the same. Income more than 12 lakh up to 15 lakh, 20% tax, and income more than 30 lakh, more than 15 lakh, 30% tax. What was the existing provision, guys? Even earlier the BEL was 3 lakh, but earlier 3 lakh to 6 lakhs was 5%, 6 lakhs to 9 lakhs was 10%, 9 lakh to 12 lakh was 15%, 12 lakh to 15 lakh was 20%, and more than 15 lakh was 30%. Now the new slab, come on, repeat with me once again, up to 3 lakh no tax, 3 lakh to 7 lakhs will be 5%, 7 lakhs to 10 lakhs will be 10%, 10 lakh to 12 lakh will be 15%, 12 lakh to 15 lakh will be 20%, and more than 15 lakh will be 30%. Please notice, we do not have 25% tax. Did you notice? After 20, we straight away go to 30, we do not have 25% tax rate. All clear? Yes, this was your first amendment in the tax rates. I'll repeat one last time. There is no change in the normal regime. In 115 BAC, there's a change only in the slab rates, no change in 87A, no change in surcharge. In the slab rates, the basic exemption limit remains the same. The maximum tax rate also remains the same. What changes are the slabs in between, right? Got it? This is your first amendment. Then comes your second amendment, which is applicable for companies. See, I'll explain it to you over here, okay? For companies, there are multiple tax rates. There are 4 tax rates, guys. And generally, students get confused that when should I apply which tax rate. So, generally, I tell students to follow a certain sequence. The same sequence I'll put even over here. Now, the first thing that you will check is, for if your company is a domestic company or a foreign company. Let's talk about domestic company first. If assessing a domestic company, you will first check is section 115BAB applicable. Now section 115BAB, the content of the section is not a part of your syllabus at the intermediate level, but you should know what are the tax rates in this section that is applicable in your syllabus. So if 115BAB is applicable, then company will have to pay 15% tax and a mandatory 10% surcharge. Okay. Cess is obvious, obviously 4% cess has to be paid. That is not something I am talking about over here. So if section 115BAB is applicable, then 15% tax and mandatory 10% surcharge. This is the first thing you will check. But let us say because of some reason 115BAB is not applicable. Then in that case you will check is 115BAA applicable. Same thing even about this section. The content of this section is not a part of your syllabus, but what is the tax rate? You should know it is a part of your syllabus. If section 115BAA is applicable, then 22% tax will be paid by the assessee plus 10% surcharge will be paid by the assessee. Even over here, cess is obvious, cess 4% has to be paid. So this is the second thing that you will check. If however section 115BAA is also not applicable, then you will see 2 years back turnover. Now come on everybody. For our May 2025 exam, what is the previous year applicable? Tell me. The previous year is 24-25 guys. Previous year 24-25, assessment year 25-26. This is the year for which you will be learning all your calculations, right? So your year is 24-25. In the third point over here, I am asking you to check 2 years back turnover. 2 years back means what? If my current year is 24-25, 2 years back will be previous year 22-23. So previous year 22-23's turnover you will check, is it within 400 crores? If it is within 400 crores, 25% tax you will have to pay, and obviously cess is as obvious, 4% cess you will have to pay. But however, if even this is not applicable, that is section 115BAB was not applicable, 115BAA was also not applicable. So 2 years back turnover you saw, even that is not within 400 crore. It is more than 400 crore, let us say. If none of this is applicable, then the general tax rate for companies is 30%. Okay. So this is a sequence that you should follow whenever you are trying to identify the tax rate applicable for domestic companies. You understood guys? I will first try for 115BAB. If 115BAB is applicable, then 15% tax and 10% surcharge I'll have to pay. If 115BAA is applicable, then 22% tax and 10% surcharge. If 2 years back the turnover is within 400 crores, then 25% tax, otherwise 30% tax. Okay, now where is the amendment? The amendment is over here. There is no change in the tax rate, there is no change in the turnover, there is a change in the year, and obviously there will be a change in the year guys, because earlier our previous year was 23-24. So when our previous year was 23-24, 2 years back will be what? 21-22. So earlier we used to check 21-22's turnover. Now because previous year has changed, obviously instead of 21-22 we will check 22-23's turnover. That's all guys. So the only change in domestic companies tax rate is in the year. The turnover is still the same, 400 crore. The tax rates are still the same. The change is in the year. Which year are we checking? Earlier we were checking 21-22's turnover. Now we will check 22-23's turnover. That's all. Okay guys, then however there is another very important change in the tax rate of foreign companies. Tax rate of foreign companies was earlier 40%, now it is going to be 35%. Now foreign companies tax computation we don't really see at the intermediate level, but from the MCQ point of view this can be asked guys. This can be a very simple 1 mark MCQ question, that what is the tax rate applicable for foreign companies? It's going to be 35%. It has been reduced from 40% to 35%. Alright, that's all. So in your basic concepts chapter, you had totally 2 amendments guys. One amendment was a change in the slab rates in 115BAC, and the second was change in the tax rate of companies. In tax rate of companies, there are 2 changes. Change number 1, for which year are you going to check the turnover 400 crores limit? For 22-23. Change number 2, foreign companies tax rate has reduced from 40% to 35%. Alright, so with this I think we are good to close the amendments in our basic concepts chapter. After this, agricultural income, no change. Residential status or scope of total income, also no change. In residential status, ensure you are thorough with deemed resident concept, guys. In scope of total income, ensure that you are thorough with interest, royalty and FTS discussion. Okay. Now coming to our salaries chapter, your first head of income. The Finance Act 2024 has made only one amendment in section 16. But I am going to discuss with you about 2 points. You will understand. Let me take you forward one by one. See, let's talk about section 16. Section 16, tell me what was the existing provision? What did I make you do in till Jan 25 exams? I told you if assessee is following the normal regime, will assessee get standard deduction, guys? Yes. Standard deduction is how much? 50,000 assessee will get. Then professional tax, whether paid by employer, whether paid by employee, total professional tax we will get as a deduction under section 16. Then entertainment allowance, remember I used to make you calculate 3 things. Out of the 3 things, whichever is the least, that is what used to be allowed under section 16. So same thing, even over here, entertainment allowance, 3 things will calculate, whichever is lesser will get a deduction. However, if assessee is following section 115 BAC, okay, then professional tax deduction we did not get, entertainment allowance deduction we did not get, but standard deduction still we got same 50,000, guys. This is how we calculated till the Jan 25 exams. But however, as per the amended provision, if you see, in amended provision, there is no change in the normal regime, guys. In amended provision, there is a change only in 115 BAC. Small, simple change only. Earlier, we were getting 50,000 standard deduction. Now, we will get 75,000 standard deduction. That's all. Understood, everybody? So if my assessee is following section 115 BAC, even now assessee will not get professional tax deduction. Even now assessee will not get entertainment allowance deduction. But standard deduction he will still get. But instead of 50,000, he will get 75,000. So to conclude, in salaries chapter, the main amendment is in section 16. In section 16, there is no change if assessee is following the normal regime. Assessee will still get 50,000 standard deduction. Assessee will still enjoy professional tax deduction. Assessee will still enjoy entertainment allowance deduction. And don't forget, entertainment allowance deduction is only for government employees. So all that will still remain the same in the normal regime. In 115 BAC, even now professional tax assessee will not get, entertainment allowance deduction assessee will not get. Then where is the change? Earlier in 115 BAC, 50,000 standard deduction assessee was getting. Now in 115 BAC, 75,000 standard deduction assessee will get. At this stage, you should ensure that you don't start thinking that, oh, standard deduction has increased. But has standard deduction increased for every assessee? No. Remember, standard deduction has increased only if assessee is following 115 BAC. In normal regime, it's still going to be 50,000 only. Okay, so this was your first amendment, your biggest amendment in salaries head in section 16. Coming to the second point now. Now this amendment is something which was made by Finance Act 2023, not by Finance Act 2024, Finance Act 2023. But this amendment did not have any applicability till 23-24 year. This amendment was applicable only previous year 24-25 onwards. So therefore your May 25 exam is the first time when this amendment will even be applicable. So that is why I am going to discuss this point with you over here. I will straight away discuss it with you with the help of an example. You will understand very easily. Alright. See, this whole amendment is relating to RFA. Now I will tell you what your whole method of thinking will be. Whenever you get a taxable value question relating to RFA, first of all you will find the taxable value of the perquisite, guys, like how you generally calculate. You remember till Jan 25 exam what we did? Till August we did a separate calculation. September onwards we did a separate calculation. Now in the current year from your May 25 exam onwards, you don't have to split the year like that. For the entire year you will do one calculation, same like what you did last year September onwards. That provision, the new provision which you applied September onwards, that provision only you will apply for the entire year, May 25 exam onwards. Okay, so taxable value of perquisite you will find like how you generally find, no change over there, normal computation only. 2011 census you will take 5%, 7.5%, 10%, those numbers you will compute, normal calculation only of the taxable value of RFA. Then you will check. There are two possibilities. Possibility number 1, this RFA which employer has given to the employee, this may be the first year in which this RFA is given to the employee. Basically what I mean is, current year is 24-25, right, in our exam. So in 24-25, it may be possible that this house was given to the employee for the first time. Before 24-25, maybe some other house was given, or before 24-25, maybe no RFA was given. So this house was given to the employee for the first time in 24-25. Either that may be possible, either 24-25 may be the first year in which this RFA is given to the employee, or your 24-25 may be a subsequent year, guys. There are only two possibilities. Either this in the current year, first time this house is being given to the employee, or the current year may be a subsequent year. Subsequent year means this house was given to the employee earlier also. Same house employee is continuing even in the current year. If this is the first year, if 24-25 was the first time when this particular house was given to the employee as RFA, then you will stop with step 1. Step 1, whatever answer you got over here, no, this only will be your taxable value, no extra drama. You will stop over here. When will the whole drama apply? Only if this is your subsequent year. If your current year, if 24-25 happens to be your subsequent year. Subsequent year means what? Subsequent year means the same RFA was given to the employee in earlier years also. Like for example, maybe in previous year 21-22, since then same house was given to the employee. 21-22 also the same RFA was given. 22-23 also same RFA was given. 23-24 also same RFA was given. 24-25 also same RFA is continuing. If the same RFA is continuing, if the current year is subsequent year for this RFA, then you will do one calculation which I will show you over here. You understood, everybody? Then only you will do something called as indexation of RFA, which I will explain to you. Okay, so you will have two steps. Your first step will be, you will check whether the your first step will be, you will normally do the taxable value of RFA computation, whatever you generally do, the way in which you generally calculate without splitting the year, no splitting till August and September and all. Whole year one calculation you will do of RFA. Then you will check, is this your first year or is this a subsequent year? If this is the first year in which RFA is being given to you, then you will stop with step 1, whatever number you get, that only will be your taxable value. But if the current year is your subsequent year, this is where this amendment which I am talking to you about will apply. If the current year is a subsequent year, then you will have to do something called as indexation. I will explain that indexation point to you over here. Let us say in previous year 22-23, this RFA was given for the first time. Okay, so 22-23 RFA was given to the employee. This was year 1 of this particular RFA. In 22-23, normal manner you did computation. Let us say that normal computation was 1 lakh rupees. Okay, then in 23-24 also the same RFA continued, guys. So 23-24 became year 2 of this RFA. 23-24 also normal computation you did. The taxable value was, for example, 1,20,000. Now your current year 24-25 you are doing RFA computation. Same RFA is continuing even in 24-25, which means 24-25 is year 3. So in my whole focus is 24-25, right? So 24-25, what you will do? You will first find the taxable value of perquisite, guys. You did the normal computation of RFA you did. It came to 1,50,000, for example. Okay. Then after this, what you will check? You will check, is this the first year or is this subsequent year, guys? What do you think? In my example, 24-25 will be subsequent year for the RFA. Same RFA is continuing since 22-23. So yes, it is subsequent year. So because it is subsequent year, this whole indexation drama will apply. So what I will do is, I will write down one small formula. The formula is, the taxable value of RFA will be whatever I have calculated over here, 1,50,000, or one more number which I will calculate now, whichever is lesser. Okay, now what is this number? This is where indexation will apply. Indexation that you do in capital gains, no, something of that sort will apply over here. You will see what is the taxable value of RFA in year 1, okay, this into CII of your current year divided by CII of year 1. This calculation you will do and you will find this number. Now you tell me, what is taxable value of RFA in year 1? What is year 1? Year 1 is 22-23, no, but be careful for this purpose, for the purpose of this calculation. If your year 1 is before 23-24, you will assume 23-24 to be year 1. 23-24 will be deemed to be year 1. If your year 1, if your real year 1 is before 23-24, then you will assume 23-24 to be your year 1. If year 1 is after 23-24, then whatever is the first year, you will take that. But if year 1 is before 23-24, then 23-24 only will be deemed to be year 1. So you will treat as if 23-24 is year 1. In year 1, what's the taxable value now? 1,20,000 into CII of current year. My current year is 24-25. You will take the CII number from the CII table, which you use for capital gains also. 363 divided by CII of year 1. The real year 1 is 22-23, but if year 1 is before 23-24, 23-24 will be deemed to be year 1. So year 1 I will take as 23-24. So year 23-24 CII is 348. So if I have to do this calculation, I will get 1,20,000 into 363 by 348. I will get 125,172. So out of these two numbers, which is the lesser number, guys? 125,172. This will be the final taxable value of RFA for 24-25. Did you all understand this point? Yes, guys, pretty straightforward. You understood, but you also got it right that you will not do this calculation every time. You will follow this sequence. Whenever you get an RFA question, first in the normal manner you will compute RFA. Then you will check is your current year the first year in which this RFA is being given to you, or is your current year a subsequent year? If it's the first year, you will stop with this answer itself. But if your current year happens to be a subsequent year, then only all this indexation drama you will do. What is the indexation drama, guys? You will see in year 1 what was the taxable value of RFA, that into CII of current year by CII of year 1. But if year 1 happens to be before 23-24, then you will assume that 23-24 is your year 1. So two important things you have to remember about this calculation. This calculation you will do only if current year is subsequent year for that same RFA. And point number 2, you should remember that if your year 1 happens to be before 23-24, in that case 23-24 will be deemed to be your year 1. Okay, guys, that's all simple. You understood? You simply have to index the year 1 number. See what indexed number you are getting. So whatever you calculated as taxable value for 24-25, you calculated 1,50,000. This or this indexed number, whichever is lesser, that only will be your taxable value of RFA perquisite. And please remember, this discussion is only for RFA and not for other perquisites. Okay, so this is it with your salaries head discussion, guys. 2 amendments we had. One was section 16 deduction. In section 16, if assessee is following 115 BSE, instead of 50,000, you will get 75,000 standard deduction. Then second point was not a Finance Act 2024 amendment, it's actually a Finance Act 2023 amendment, but applicable from 24-25 onwards only. That's why we discussed this, indexing your RFA number. Okay, now let's come to the second head of income. Your second head of income is IFHP. We have a very small simple amendment only over here. I'll explain it to you over here. Listen to me carefully. Very easy only. See, if your assessee has a house property, when will this house property be assessed under the PGBP head? There are only 2 situations when a house property will be assessed under the PGBP head. Situation number 1, if the property is self-occupied for business or profession. Like for example, I have a house and I'm carrying on my profession from this house. Let's say I'm carrying on my CA practice from my house. So in this case, my house is being self-occupied for my business or profession. So this whole house will not come under IFHP, it will go under PGBP. Okay, you must have done questions on this. Remember, we worked worked out a question on this in IFHP as well, in PGBP as well. We had worked out a question where the same house, let us say 50% of this house is self-occupied for residence, 25% of this house is let out, and 25% of this house is self-occupied for business. So in that case, this 25% which is self-occupied for business, this alone is assessed under the PGBP head, guys. So that is my first situation where the property is self-occupied for business or profession, then the property will be assessed under PGBP. Okay. Then comes the second point, if it is assessee's business to let out properties. I am not saying real estate business. We have discussed all this in full depth already in class, you remember very well, I'm hoping. We had learned, remember the difference between real estate business and business of letting out properties. We are not talking about real estate business over here. We're talking about business of letting out properties. Business of letting out properties means my assessee's business is buying properties and not selling them. See, if assessee is buying and selling, that will become real estate business. I am talking about business of letting out properties, which means assessee's business is to buy properties and then give them on rent. Okay, even in such case, the property will be assessed under PGBP, which means whatever rental income you get, that rental income will be taxed under PGBP head and not IFHP head. So this was the provision earlier, guys. So, but now where is the amendment? The amendment now is in the second point. The law very clearly says now, if assessee is in the business of letting out commercial properties, then only the property will go under the PGBP head. Earlier, if assessee is in the business of letting out properties, whether it is residential property, whether it is commercial property, both used to go under the PGBP head. Now specifically they have mentioned commercial properties, that only if assessee is in the business of letting out commercial properties, then only the property will go under the PGBP head. Understanding. So as per your amended provision now, when will a house property go under the PGBP head, guys? Only in two situations. Situation number one, when the property is self-occupied for business or profession, same like my first point. Second situation, when assessee is in the business of letting out commercial properties. So this means if assessee is in the business of letting out residential properties, it will stay under the IFHP head only. Okay, see, look at this table, you will get even better clarity. Look at just the amended provision. Okay, if assessee is in the business of letting out residential properties, it will stay under IFHP only. If assessee is in the business of letting out commercial properties, this only will go under PGBP head. Earlier, if assessee is in the business of letting out properties, whether residential, whether commercial, if his business itself is to let out properties, the property used to go under PGBP. But now, if assessee is in the business of letting out residential property, it will stay under IFHP head only. Only if assessee is in the business of letting out commercial property, only that will go to the PGBP head. One small simple point in your IFHP chapter. Okay, so now you will conclude this way, that there are two situations in which a house property goes under the PGBP head. Number one, when the property is self-occupied for business or profession, and number two, when it is the assessee's business to let out commercial properties. If assessee's business is to let out residential properties, that will not go under the PGBP head. The residential property will always stay under IFHP head only. Only if assessee is in the business of letting out commercial properties, only that will go under the PGBP head. Residential property, even if it is assessee's business to let it out, residential property will stay under IFHP only. Okay everybody, the whole reason behind the amendment is pretty straightforward. In PGBP, when I tax my property under the PGBP head, the taxable value is generally lesser. So people were misusing this point. They were trying to, indicate as if it is their business to let out properties, and even residential properties they were assessing under PGBP, so that taxable income is less and tax is less. So therefore the finance minister said nothing doing. Only if your assessee is in the business of letting out commercial properties, only commercial properties will go under the PGBP head, but residential property will stay under the IFHP head only. Okay, now see, just to ensure that there is no confusion, listen to me. There are totally four possibilities. Okay, assessee has rental income, for example. Okay, now possibility number one, assessee is not in the business of letting out properties. Assessee has let out a residential property, assessee has let out a commercial property. And this is not the business of the assessee. Assessee's business is, let's say, manufacturing business. He just bought one property and kept, and he is letting it out. So he is not in the business of letting out properties. He just has an asset in the form of a house, he has let it out, or he just has some office space and he has let it out. Then another situation possible is assessee is in the business of letting out properties, and assessee has let out residential properties, assessee has let out commercial properties. I want answers only from the point of view of the amended provision. Okay, tell me, if assessee is not in the business of letting out properties, residential property will be assessed under IFHP, commercial property will also be assessed under IFHP, because you can put something in the PGBP head only in two situations. Tell me, over here, is my assessee self-occupying the property for business or profession? No, it is let out property. It is not self-occupied property. Is assessee in the business of letting out properties? He is not in that business. He is into manufacturing business. So therefore, only in these two cases only you will put the property under PGBP. All other cases, property will stay under IFHP only. But however, if assessee is not in the business of letting out properties, if assessee is in the business of letting out properties, then residential property will always stay under IFHP only. Commercial property is what will go under PGBP. Now no confusion, right? So what will go under PGBP? Commercial property, that too only if assessee is in the business of letting out properties. The reason why I gave this table for you is that you should not think that commercial property will always go under PGBP. Commercial property will go under PGBP only if it is assessee's business to let out commercial properties. Now no confusion. And what if assessee is into real estate business, guys? Assessee is into real estate business means his business is to buy and sell properties. So if assessee is into real estate business, whatever land and building he owns, that is his stock in trade. So let's say he was not able to find buyer for one particular building. So he thought, instead of letting this building stay vacant, might as well give it on rent temporarily. So if assessee is into real estate business, and here if he is giving a property on rent, residential property, commercial property, which head will this go to? See, residential property will always come under IFHP head only. Commercial property will go under PGBP head only if it is assessee's business to let out properties. Here assessee's business is not letting out properties. Assessee's business is real estate business. So even here it will stay under IFHP only. You understood, everybody? So the point is very simple. You got to stay stubborn with respect to your concept. The concept is a property will go under PGBP only in two cases. Either if it is self-occupied for business or profession, or if assessee is in the business of letting out commercial properties. Business of letting out properties and real estate business are not the same. So real estate business will, in real estate business, what will go to PGBP? In real estate business, assessee is buying and selling properties. No, that gain, like assessee bought a house for 10 lakh, sold it for 12 lakhs, that gain of 2 lakhs, that will go under PGBP head. Okay, but in real estate business, let's say by chance assessee is having some rental income, that will come under IFHP head only, because real estate business is not the business of letting out properties. But if assessee is in the business of letting out properties, only commercial property will go to PGBP. At the same time, you should not start thinking that every commercial property will go to PGBP. Commercial property will go to PGBP only if it is assessee's business to let out properties. Residential property will always stay under IFHP only. Okay, perfect clarity, left to right, right to left, top to bottom, bottom to top. I've tried discussing this with you from all angles because according to me, this is highly probable in your upcoming examination. Alright, so this is it with your IFHP adjustment. Now let's come to PGBP amendments. Here we have two amendments and both are extremely important, but both are very simple. Your first amendment is relating to employer's contribution to NPS. See, let me discuss this whole concept with you. See, the reason is there is a similar amendment in your chapter 6A also. So I'll discuss both now itself with you. Our whole focus is on employers' contribution to NPS, National Pension Scheme, Atal Pension Yojana, New Pension Scheme, whatever you want to call it. So employer has made a contribution to NPS. Let's discuss about this adjustment from the employer's point of view and from the employee's point of view. See, from the employer's point of view, don't you think it is an expense, guys? And don't you think it is an expense relating to business or profession? So definitely this expense should be allowed in the computation of PGBP. Yes, it is allowed. Even earlier it was allowed. But there is a maximum limit, that how much maximum will it be allowed. Earlier the limit was it will be allowed up to 10% of salary of employees. But now this 10% number has been changed to 14%. Got it, guys? You understood the amendment? The maximum limit has changed. Earlier up to 10% of employee salary only was allowed. Now 14% of employee salary is going to be allowed. And salary means what? That remains the same. Salary means basic salary plus DA forming part, full stop. Okay. Now this is from the employer's point of view. So conclusion, employer's point of view, whatever he is contributing to the employee's NPS, it is an expense for him, and this expense is relating to his business or profession. So the expense should be allowed for him in the computation of PGBP, but there is a maximum limit. The maximum limit is 14% of the employee salary. Now come on everybody, let's think from the employee's point of view. Now don't you think from the employee's point of view, it's first of all a benefit for him, guys, a benefit that he has received from his employer. Come on, in his account, in his NPS account, the employer has contributed. So whatever money is there in his NPS account, it will be of his benefit after his retirement. So it's clearly a benefit for him, and therefore this benefit will be taxable for him under the salaries head. Yes, guys, come on. What I'm trying to do is I'm trying to not just discuss the amendment with you. I'm trying to give you a 360-degree discussion of the entire concept, so that you are not just learning the amendment. The entire concept relating to the amendment is being taught to you. That way you will get much better clarity. Listen again. So from the employee's point of view, it's a benefit for the employee. Employer is contributing into his account. Now any benefit that I get from my employer will be taxed under the head salary. So even here it will be taxed under the head salary. Okay. Then after this, I will get chapter 6A deduction, guys. This point was there even earlier. In chapter 6A, you will get section 80 CCD subsection 2. Now 80 CCD subsection 2 is something which you get both. You get this deduction under the normal regime also, under 115 BAC also. In both the regimes, 80 CCD subsection 2 you get. Now how much deduction do you get? What was the existing provision? Under 80 CCD subsection 2, the maximum deduction that you will get is depending upon who the employer is. If the employer is central government or state government, then the maximum deduction you will get is up to 14% of salary of the employee. If the employer is any other employer, then the maximum deduction that you will get is 10% of salary of the employee. And salary remains the same, basic salary plus DA forming part, guys. This is what we had learnt earlier, and the same point will apply even if assessee is following 115 BAC. If employer is central government or state government, then the maximum is going to be 14% of salary. If any other employer, 10% of salary. This is how you would have learnt it. Now where is the amendment? From employer's point of view, we are increasing the maximum limit from 10% to 14%. From employee's point of view, in the salaries head it will be taxed, no change. 80 CCD subsection 2, you will get a deduction of employer's contribution, no change. 80 CCD subsection 2, you will get a normal regime also, 115 BAC also, no change. In normal regime, maximum deduction you will get is 14% of salary if employer is central government, state government. Otherwise 10% of salary, no change. Then where is the change? Change is over here. If assessee is following 115 BAC, your maximum deduction is going to be 14% of salary. Whether the employer is central government, state government or any other employer, it doesn't matter. Your maximum deduction is going to be 14% of salary. This is the point which you will be seeing later in chapter 6A as well. I'll cover that also for you now itself. Look at this. In chapter 6A, if the employer's contribution to NPS, you get a deduction under 80 CCD subsection 2. Earlier, how much maximum deduction you were getting? If employer is central government, state government, 14% of salary, any other employer 10% of salary. And the same provision was applicable under the normal regime also, under 115 BAC also. But as per the amended provision, if assessee is following 115 BAC, doesn't matter who the employer is, your maximum deduction is going to be 14% of salary. So what we have done right now is, we have done an entire discussion of this employer's contribution concept from both the employer's point of view and from employee's point of view. You understood, right? In employer's point of view, maximum deduction is going to be 14% of salary of the employees. Whether assessee is following normal regime 115 BAC doesn't matter. Employee's point of view, under the normal regime, you have two numbers, 14% and 10% number. But under 115 BAC, irrespective of who the employer is, you will get maximum 14% of salary as deduction under 80 CCD 2. Salary remains the same, basic salary plus DA forming part, full stop, no commission. Understood, everybody? So this was your amendment relating to employer's contribution to NPS. Now coming to section 40B. Section 40B has undergone a major amendment. The whole section has been revamped. When I say that the whole section has been revamped, the numbers have changed. Alright. Now let us talk about section 40B in full detail. Listen to me. What does section 40B talk about, guys? Section 40B talks about two things. By the way, in section 40B, who is your assessee? Your assessee is either a partnership firm or an LLP. Right, guys? So section 40B generally talks about two things. Thing number one, whatever interest the firm, when I say firm, I am covering both partnership firm and LLP, okay? 40B covers two transactions. Transaction number one, whatever interest the firm pays to the partners, guys. This interest, how much we allow, tell me. Think from the firm's point of view. From the firm's point of view, if you see, it is an expense. This expense is allowed in the computation of PGBP. But how much of this interest will be allowed? Only maximum 12% per annum interest rate will be allowed, guys. From the partner's point of view, if you see, this interest will be taxable under the head PGBP. But what will be taxable under the head PGBP? Whatever is allowed for the firm, that same amount will be taxable for the partner. This is what you have learnt already. No change over here, guys. This continues as it is. No change in interest. Then comes the second point that section 40B talks about. This time my firm is giving salary to my working partner or active partner. Now for the firm, if you see, this is going to be an expense, and for the firm this expense is going to be allowed. But how much is allowed depends upon the book profits, right? You know how we compute book profits, guys? Normal, usual PGBP without considering salary to partners. Here you have the unabsorbed depreciation adjustment and all, which we've done already. Now when if your assessee is a firm, for the firm the salary is an expense. This expense will be allowed, but how much will be allowed depends upon the book profit of the firm. Now there are two possibilities. Either this book profit will be a loss or this book profit will be a profit. If this book profit is a loss, maximum how much salary do we allow? Maximum 1,50,000 salary we allow. If it is a profit, then we will do two calculations. Up to 3 lakh of the profit we will do a separate calculation, and profit above 3 lakh we will do a separate calculation, guys. Profit up to 3 lakh we do this way, 90% of the book profit or 1,50,000, whichever is higher. This is going to be the maximum salary which is allowed for the firm. And if the book profit is more than 3 lakh, on the excess we will calculate 60% of the excess book profit, guys. So this is what is allowed for the firm, and whatever is allowed for the firm is taxable for the working partner. Now where is the amendment? The amendment is over here only. See, earlier the limit, whatever are the limits, okay, whatever are the numerical limits, they've been made double, simple. So if the book profit happens to be a loss, then maximum 3 lakh salary will be allowed for the firm. If the book profit is a positive number, then up to 6 lakhs of the book profit, 90% of the book profit or 3 lakh, whichever is higher. I am just making the numbers double, right, guys? Up to 6 lakh of the book profit, profit, 90% of the book profit or 3 lakh, whichever is higher. If the book profit is more than 6 lakhs, then 60% of the excess book profit. So all the numbers have just been made double. Okay, so that is what the whole amendment is about. There is no change in interest. If the firm is paying interest to partners, for the firm up to 12% of the interest will be allowed, provided it is given in the partnership deed. Whatever is allowed for the firm is taxable for the partner. Story simple, story over. Then second part, when the firm is giving salary to working partner, then for the firm the salary is an expense. For the firm the salary will be allowed. But how much salary will be allowed? What is the maximum salary that will be allowed? The maximum salary that will be allowed will depend upon the book profit, guys. If it's a negative number, maximum salary that will be allowed will be 3 lakh for the firm. If it's a positive number, up to 6 lakh of the book profit, 90% of the book profit or 3 lakh, whichever is higher, this will be the maximum amount which will be allowed for the firm. And if it is more than 6 lakhs, then 60% of the excess book profit is what will be allowed for the firm. Alright, now but what if it's a sleeping partner? This whole discussion was, what if the firm is paying salary to working partner? But what if the firm is paying salary to sleeping partner? No change in that. If the firm pays salary to sleeping partner, for the firm the entire salary will be disallowed. For the partner it will not be taxable. For the firm entire salary will be disallowed. For the partner nothing will be taxable. There no change. Change is only for active partners. No change in interest. No change in interest, 12% number stays the same. In interest, partner can be active partner, sleeping partner, doesn't matter. No change over here. Change is only in the salary calculation, salary given to the working partners. So same thing you will see even over here. On the first 6 lakh of the book profit or on loss, 90% of the book profit or 3 lakh, whichever is higher. On the balance book profit, 60% of the book profit. So the numbers have just been made double. 3 lakh has changed to 6 lakhs, 1 lakh 50 has changed to 3 lakhs. The numbers have just been made double. Okay, let's take one small example, guys. Let's take an example. Let's do the calculation and see. Let's say the book profit of your partnership firm was rupees 8 lakhs. Okay, and the salary which my partnership firm has paid to the partners is 20,000 per month to 2 partners, and both the partners are working partners, let us say. So totally my firm has paid 4,80,000 salary my firm has paid to the partners. I need to know what is the salary that will be allowed for the firm. Okay, let's do the computation, guys. We will first do the entire computation from the firm's point of view. So what does section 40B say? It all depends upon the book profit. Now had the book profit been a negative number, then you would have straight away said that the maximum allowable amount is 3 lakhs. But here book profit is a positive number. Book profit is 8 lakhs. So how will you calculate? Up to 6 lakhs of the book profit you will have a separate calculation. On the excess 2 lakhs of the book profit, you will have a separate calculation. On this 6 lakhs, how will you calculate? 90% of this 6 lakhs or 3 lakhs, whichever is higher. 90% of 6 lakh will be 5,40,000 or 3 lakhs, whichever is higher. Clearly 5,40,000 is higher. On the excess 2 lakhs, how will you calculate? 60% of this 2 lakhs. So 60% of 2 lakh is going to be 1,20,000. Now if you see, what is the total maximum amount? 5,40,000 plus 1,20,000. This is going to be 6,60,000. This is the maximum allowable working partner salary. My firm has paid 4,80,000 only. It is within the limit of 6,60,000. So 4,80,000 will be fully allowed for the firm. Understood? So there are 2 amendments in your PGBP chapter. To summarize, number 1, employer's contribution to NPS. Maximum 14% of employee salary will be allowed for the employer. Similar amendment is made in chapter 6A 80 CCD subsection 2 from employees point of view. But that amendment is only if assessee is following 115 BAC. If assessee is following 115 BAC, whether the employer is central government or state government doesn't matter. For whether the employer is any other employer also, it doesn't matter. For the employer's contribution, 14% of salary will be allowed under 115 BAC. In normal regime, we still have to remember both the numbers. In 115 BAC, only 14% number we will remember. But please don't forget, the PGBP amendment will apply whether assessee is following 115 BAC or normal, doesn't matter. For all employers, whatever contribution they are making to NPS, 14% of employee salary will be allowed for them. Then the second amendment was in section 40B, extremely important from examination point of view. Whatever interest my firm is paying to the partner, 12% is allowed, no change in that. If firm is paying salary to sleeping partner, it will be disallowed for the firm, no change in that. Where is the change? If firm is paying salary to active partner, to working partner, then the calculations change. On the first 6 lakh of book profit, 90% of the book profit or 3 lakh, whichever is higher. On the balance book profit, 60%. So whatever you get, this will be the maximum allowable working partner salary. In my example, firm was paying only 4 lakh 80 guys. It was within the limit of 6 lakh 60 guys. So 4 lakh 80 will be fully allowed. But if this salary was more than 6 lakh 60, like for example, let's say firm was paying 10 lakh salary to the partners. If firm was paying 10 lakh salary to the partners, we would have allowed only 6 lakh 60, balance would have been disallowed. So what you are calculating over here is a maximum allowable working partner salary. And remember, whatever is allowed for the firm, that only will be taxed for the partner. So in my example, how much are you allowing for the firm? 4 lakh 80 is what you're allowing for the firm because it is within the limit. So whatever you're allowing for the firm, this only will be taxable for the partners. Okay. So with this, we're done with our PGBP amendments also. Now coming to the most talked about amendments, the capital gains amendments. Here there are around 8 amendments guys, but please do not be worried about them. Do not look at them like one big burden, because trust me, they are not all that difficult. Unnecessarily hype is getting created. If you learn them in the correct manner, it's actually pretty straightforward. Till here you've understood them all guys. Come on, let's do one quick revision so that our confidence is nice and high, and then we'll start capital gains. My very first discussion with you was 115 BAC, the slab rates changed. Then for companies, instead of previous year 21-22, you will take 22-23, that's all. Everything else remained the same. Foreign company, tax rate reduced from 40% to 35%. In salaries, standard deduction changed to 75,000, but only if assessee is following 115 BAC. In RFA, if the same RFA is given to the assessee for multiple years, that is, if this year is a subsequent year for that RFA, then we will do indexation guys. And remember here, if year 1 was before 23-24, we will assume 23-24 is year 1. Then in our IFHP, we discussed that if assessee is in the business of letting out commercial properties, that only will go to PGBP. If assessee is in the business of letting out residential properties will always stay under IFHP head only. Then in PGBP, we learnt employer's contribution to NPS will be allowed for the employer, maximum 14% of salary, and section 40B limits have changed. Simultaneously, we also covered chapter 6A. Chapter 6A ATCCD subsection 2 we discussed. Under section ATCCD subsection 2, if assessee is following 115 BAC, doesn't matter who the employer is, maximum deduction allowed for the employee is 14% of salary. In normal regime, if employer is central government, state government, then only 14% number applies. Otherwise, 10% number applies. But if assessee is following 115 BAC, doesn't matter who the employer is, the limit will be 14% for everybody. Okay, confident till here, understood till here, that itself should give you nice energy to, go on into the capital gains discussion. Listen to me, 8 amendments, simple amendments, one by one we will take and we will sort it out. Okay. My first amendment is relating to period of holding. See, and one more thing, in capital gains, whatever amendments we learn, okay, all of these amendments are applicable only with effect from 23rd July 2024 because this was the date on which the budget was announced. Okay, there is one amendment which is applicable for the entire 24-25 and there is one amendment which is applicable with effect from 1st October 2024. All the other amendments that we've learned till now, whatever amendments we've learned, they are applicable for the entire year. Whatever amendments we've learned till now are applicable for the entire year. But in capital gains, we have three categories of amendments. One amendment is applicable for the entire year. Most of the amendments are applicable only with effect from 23rd July 24 and one amendment is applicable with effect from 1st October 2024. Okay, so three categories of amendments we'll have to remember these dates. Okay, my first amendment, I'm going to discuss with you all those amendments which are applicable only 23rd July 24 onwards. Okay, my first such amendment is relating to the period of holding. Come on guys, let's discuss what was the existing provision. With respect to period of holding, we had three relevant periods guys. We had 12 months, we had 24 months and we had 36 months. That is, if assessee is holding the asset for more than 12 months, more than 24 months or more than 36 months as the case may be, then it becomes a long-term capital asset. If it's up to 12 months, up to 24 months or up to 36 months, then it becomes short-term capital asset. 12 months criteria is applicable for what? 12 months is applicable, number one, for listed securities. It can be shares, debentures, bonds, any listed security. Then for listed or unlisted units of equity oriented mutual fund, listed or unlisted zero coupon bonds, and listed or unlisted units of UTI. For these four assets, your relevant period of holding was 12 months guys. 24 months was for only two assets, which is number one, unlisted shares, not unlisted securities, unlisted shares, and number two, immovable property. For these two you had 24 months and for all others we had 36 months. This is how we used to learn. Now if you see the amended provision, there is nothing called 36 months. Now we have only two categories, 12 months, same four assets. For everything else, it's going to be 24 months only. So earlier in 36 months, we used to have, for example, a slump sale used to fit under 36 months. Then unlisted debentures used to fit under 36 months. Then jewels used to fit under 36 months. Then units of debt oriented mutual fund used to fit under 36 months guys. Now no concept of 36 months, which means as per the amended provision, there are only two relevant periods of holding, 12 months and 24 months. 12 months for these four, for everything else it is 24 months only. Understanding, but this amendment is applicable only if the date of transfer is on or after 23rd July 2024, which means if the so you know what you'll have to do whenever you do your capital gains computation, you will have to check what the date of transfer is. If the date of transfer is before 23rd July 24, you will think that there are three periods of holding, but if the date of transfer is on or after 23rd July 24, then you have only two relevant periods of holding. If it is one out of these four assets, then 12 months, anything else 24 months. Understood? Can I ask you some questions? Will you try to answer? Let's see how nicely you're listening. You have to tell me about both. What if the date of transfer is before 23rd July 24 and what if the date of transfer is on or after 23rd July 24? You'll have to give me both the answers. Okay, tell me what if they are listed shares, shares listed in a recognized stock exchange in India. Then what is the relevant period of holding if date of transfer is before 23rd July 24? Here it will be 12 months guys. And what if the date of transfer is after 23rd July 24? Here also it will be the same 12 months. But what if they are unlisted shares? Unlisted shares, it was 24 months earlier, even now it is going to be 24 months only. What if it is listed debentures? Listed securities guys, earlier also 12 months, Now also 12 months. What if it is unlisted debentures? Unlisted debentures, earlier the relevant period of holding was 36 months, but now it will be 24 months. Wherever it was 36 months earlier, that will all change to 24 months. No 36 months criteria anymore. What about jewels? Earlier, the relevant period of holding was 36 months, guys. Now it's going to be 24 months. Then what if the capital asset happens to be a house property? If the date of transfer is before 23rd July 24, 24 months. If the date of transfer is on or after 23rd July 24, it will stay the same, 24 months. Understood, everybody? So this is your first amendment in capital gains. Easy amendment, guys. Not a big task. We just have to remember that we don't have the 36 months criteria anymore. That's all. And also remember that you'll have to check what is the date of transfer. On that basis only you can conclude. If the date of transfer is before 23rd July 24, then you will check all the 3 time limits. Only if the date of transfer is on or after 23rd July 24, only then you will conclude that there are only 2 periods of holding. One is 12 months and the other is, for everything else it is 24 months. Okay, everybody? Yes, clear? So this was your first point in your capital gains chapter. Okay, now comes your second point in your capital gains chapter, which is about indexation. See, what was your existing provision? Your existing provision is that if the capital asset is a long-term capital asset, then for cost of acquisition and for cost of improvement, for these 2 numbers you do indexation, guys. But there are some assets, even though they are long-term capital asset, you don't do indexation. As per the amended provision, if the date of transfer is on or after 23rd July 24, whether long-term, whether short-term, doesn't matter what the asset is, doesn't matter who the assessee is, no indexation at all. No indexation at all. But you must have read in the news and all that indexation is restored. You must have read in the news that indexation has come back for assessees individual and HUF for immovable property. That we will discuss a little later. In the 4th or the 5th point we will discuss that. Let me take you in the flow in which I think you will understand better. Leave the process on me, please. Okay, trust me, I'll cover it for you. For now, how will you remember if the date of transfer is on or before 23rd July 24, like how you generally do indexation? Same way, guys. Short-term capital asset, no indexation. Long-term capital asset, you will do indexation. But even if it is long-term capital asset, bonds, debentures, your slump sale cases, 112A cases, your depreciable assets and all, you will not do indexation. All that will remain the same. But if the date of transfer is on or after 23rd July 24, no indexation at all. Okay. Now for RFA, I gave you a sequence of thinking. With that it has become easy. RFA, what did I tell you? You will first do normal RFA calculation. Then you will check, is my current year first year or subsequent year? If it is first year, you will stop with that number. If it is subsequent year, then you will do that indexation and all you will do, right? So that method of thinking will give you a good, it will ensure you don't get confused in the examination. The reason why I always tell students to learn with sequence in direct taxes, because otherwise when you see a question in the examination, 1000 adjustments will come to your mind at the same time. Now which one to take, which one to do first, which one to do second, it will become very confusing. So that is why learn with a sequence. Same way I'll give you a sequence for capital gains also. Capital gains, see guys, how do you do your capital gains calculation? What have I taught you? I tell you first check what capital asset are we transferring. Then next line, I make you write the period of holding. Then we conclude long term or short term. Over there, we have to check, we write the period of holding, right? See, first we write what is the capital asset. Like for example, let's say the capital asset is immovable property. Then we will write the period of holding. Now when we write the period of holding, we write the date of acquisition and we write the date of transfer, guys. Here you have to pause for a moment. You have to see what is the date of transfer. If the date of transfer happens to be on or after 23rd July 24, then you have to remember 3 things. Thing number 1, period of holding only 2 you have. Thing number, okay, not able to see, 1 minute. Now I'm hoping it's visible. Yes, so I'll repeat again. Whenever you do your capital gains calculation, you will check what the date of transfer is. If the date of transfer happens to be on or after 23rd July 24, then 3 things will get impacted. Thing number 1, period of holding only 2 periods you will have. Thing number 2, you will not have any indexation benefit even if it is long-term capital asset, still no indexation benefit. And thing number 3, taxation of capital gains will change. This I will be discussing with you next. Okay, so this thinking you remember, please. This sequence you remember, please. When you see the question, when you read the question, do this identification. Once you do this identification, you will get one guidance to solve the entire question. You will have to see what the date of transfer is. Is it on or after 23rd July 24? If it is on or after 23rd July 24, then you will have to remember only 2 periods of holding, 12 months, 24 months, no indexation, and taxation. How do you compute tax of capital gains? That will change. Okay, so periods of holding you have only 2. For 4 assets, 12 months. For everything else, 24 months. But you have to remember both the provisions, because before 23rd July 24 though you have 3. So you'll have to remember both the provisions. Earlier, for these 4 assets, 12 months. For unlisted shares, not unlisted securities, unlisted shares and immovable property, 24 months. For everything else, 36 months. But if the date of transfer is on or after 23rd July 24, then 12 months for these 4 assets. For everything else, 24 months. Then, if your asset is transferred before 23rd July 24, then normal way indexation you will do. But if the date of transfer is on or after 23rd July 24, then no indexation. Okay. Then CII number for 24-25 is 363. This is fine. Then remember I was telling you that there is one amendment which is applicable for the entire year. That is this one. See, you remember, you must have learnt in section 47 that there are some transactions which are not considered as transfer. You must have learnt if assessee is giving a gift, gift is not a transfer, and because it is not a transfer, no capital gains tax. Similarly, if there is any transfer of asset under a will, even this will not be considered as a transfer. If no transfer, no capital gains. So this was the provision which you had learnt, and earlier this was applicable for all assessees. Now the amendment is that this is applicable only for individuals and HUF, not for others. The logic is pretty simple. For gift, there is a precondition of natural love and affection which can be expected only out of an individual or HUF. So the amended provision is that if an asset is being transferred by way of gift or by way of will, you will say it is not a transfer. You will say that there is no capital gains only if assessee is an individual or HUF. If assessee is any other assessee, it will be considered as transfer. Even gift will be considered as transfer. Like if a company is gifting its shares, it will be considered as transfer. There will be capital gains. Only if gift or will is, only if transfer by way of gift or by way of will is by individual or HUF, only then it will not be considered as transfer. Understood, guys? So conclusion, gift, will, not a transfer, no capital gains, provision applicable only for individual HUF. If assessee is any other assessee, gift will be considered as transfer, there will be capital gains. Okay, so this is it about your 4th amendment. Alright, now comes your 5th amendment. This is regarding LTCG taxation. See, what was your first amendment? Period of holding. Only 2 periods you have after 23rd July 24, 12 months and 24 months. Second amendment, no indexation anymore. Third amendment, CII for the current year is 363. Fourth amendment, gift, will, not a transfer. All that is only for individual HUF. Now comes your fifth point, the most important point inside your capital gains amendments, the LTCG taxation and then STCG taxation. Give me your 200% in this discussion, guys. It will be so worth it. Once we are done with these two amendments, we would be done with most of it. The remaining will be pretty straightforward. Okay, listen to me. LTCG taxation and STCG taxation. Let me give you some background first. See, if assessee is having LTCG, we generally first try to tax it under 112A. If it is not taxable under 112A, then we put it under 112, guys. Similarly, if assessee is having STCG, we first try to tax it under 111A. If 111A is not applicable, we tax it as per the slab rates, normal computation as per the slab rates, right guys? Now, these three sections are special rates of taxation. That is how we have learned. Now, all these three sections have undergone an amendment. We'll see one by one. Let's take up section 112A first. Now 112A, what was the existing provision? We have to know what the existing provision is because the amendment is applicable only if the date of transfer is on or after 23rd July 24. So we have no choice. We have to learn the old provision and the new provision. Not a problem. Easy only. We will learn without complaining. Okay. Listen to me. 112A, what was the existing provision? Condition 1, the long-term capital asset has to be listed equity shares, guys. Point number 1. Or it has to be listed units of equity-oriented mutual fund. Or it has to be listed units of a business trust. This is what you have learned. First condition, the asset has to be listed equity shares or listed units of equity oriented mutual fund or listed units of business trust. Then you should pay STT. Should you pay STT at the time of acquisition or should you pay STT at the time of transfer? You would have learned for listed equity shares you must pay STT both at the time of acquisition also, at the time of transfer also. Listed units of equity oriented mutual fund, listed units of business trust, you must pay STT at the time of transfer. This is the first condition, right guys? So if it is long-term capital asset and if it is any of these three assets, and condition 2, you must have learned that the date of transfer has to be on or after 1st April 2018. This condition is not relevant anymore because of course in our examination, our assessment year is, our previous year is going to be 24-25, which is far away from here. So not much relevant anymore, but still I'll discuss it with you. I have two conditions. If both the conditions are fulfilled, then welcome to section 112A. What does 112A say? 112A says we will see how much is your LTCG. If LTCG is up to 1 lakh, then it is going to be fully exempt. But if LTCG is more than 1 lakh, we will see what is the excess above 1 lakh. On that excess, 10% tax, guys. But however, 112A goes on to say that we will not give you any indexation benefit, even though it is long term, no indexation benefit. And then section 87A rebate you will not get. Then chapter 6A you will not be able to enjoy against this income. Then if you have any unutilized basic exemption limit, it can be adjusted against this income, but only if the assessee is a resident assessee. And then you must have also learned how to compute cost of acquisition in such cases. It all depends upon what the date of acquisition is. If the date of acquisition happens to be before 31st Jan 2018, on or before 31st Jan 2018, you have a separate calculation. But if the date of acquisition happens to be after 31st Jan 2018, then you will take the actual cost of acquisition as it is. If the date of acquisition is on or before 31st Jan 2018, then what will you do? You will see what is the actual cost of acquisition or FMV on 31st Jan 18 or FVC. Out of these two numbers, whichever is lesser, and out of these two numbers, whichever is higher, guys. Now, what I've done for you over here is, I've basically discussed the whole section 112A, the existing provision. Now, where is the change? Even now, long-term capital asset, same 3. Even now, STT you must pay both at the time of acquisition and transfer for listed equity shares. For the other two, only at the time of transfer. In both, the date of transfer should be on or after 1st April 2018. Even now, section 112A, no indexation, no 87A, unutilized BEL you can adjust, no chapter 6A, cost of acquisition calculation and all remains the same. Where is the change? The change is over here. The same numbers will apply if date of transfer is before 23rd July 2024. If the date of transfer is on or after 23rd July 24, then instead of the 1 lakh number, the 1,25,000 number will apply, which means LTCG up to 1,25,000 will be exempt. If it is more than 1,25,000, I will see what is the excess. The excess alone will be taxed at the rate of not 10%, 12.5%. Understood, guys? So where is the change? There is no change in the assets, in STT point, in indexation 87A point, in special rate point, in your cost of acquisition and all. There is no change. All that remains the same. Where is the change? The change is only in the tax calculation. You remember, guys, when I was telling you the sequence, I told you in May 25 exam, September 25 exam, Jan 26 exam, whenever you have a question relating to capital gains, the first thing that you will check after capital asset is what is the date of transfer. If it is on or after 23rd July 24, then three things will get affected. Period of holding only 2, no indexation, and taxation will change. The taxation point only I am discussing with you now. The taxation point under section 112A, if the date of transfer is before 23rd July 24, then up to 1 lakh, no tax, and capital gains above 1 lakh, whatever is the excess, on the excess 10% tax. This 1 lakh number has changed to 1,25,000. This 10% number has changed to 12.5%. And you know, right, when do we do about all this thinking? We do this 1 lakh number and all only at the time of tax computation. Right, guys? When we are doing the capital gains computation and all, we don't apply all this. Same thing even over here. Even in the amended provision, I will think about the 1,25,000 number only when I am doing the tax computation. When I am doing the capital gains computation and all, I will not think about it. Like for example, if my capital gains is 75,000 only, it is less than 1,25,000, no problem. It will still form a part of my total income. Only when I do tax computation, I will think, oh, 75,000 is within 1,25,000, hence no tax. So I will think about all this only when I do tax computation. All those points I have mentioned for you over here. Okay, whole section also I have brought for you over here. The other common points, the amendment is in this table. Can I give you one example now? Let us see how well we are understanding, guys. Yes, see. Let us say my assessee sold listed equity shares. Okay, as STT was paid at the time of purchase also, at the time of transfer also. There are 2 instances in the year when my assessee sold. Okay, first my assessee sold on 1st of May 2024 and one more sale happened. So both of these are dates of transfer. Alright, one more sale happened, let's say on 1st of October 2024. So 2 transfers happened. From this first transfer, you did the capital gains computation. Your capital gains under section 112A was, let us say, 75,000. Then 1st October 2024, again the sale happened. Again you did capital gains computation. Here the capital gains amount was 1 lakh. Okay. Now the question before us is, what is going to be the tax liability of this assessee? I am going to make one assumption over here. I am going to assume that assessee is having normal rate income of more than basic exemption limit, which means I am going to assume that there is no unutilized BEL. If there is unutilized basic exemption limit, we can adjust against 112. You know, I don't want to do that, so I am going to assume that there is no unutilized BEL. I am going to assume other income and all is more than BEL. So full BEL is utilized. There is no unutilized BEL. Now what is a taxation number? How will we compute? See, The whole point depends upon the date of transfer. The date of transfer is 1st May 24. The date of transfer is before 23rd July 24. So here which number will apply? 1 lakh number will apply, guys. This amount is within 1 lakh and hence it's going to be exempt. There's going to be no taxation, guys. To see how much capital gains will form part of your total income. The entire 1,75,000 will form part of your total income. Okay, but how will you compute tax? When you come to the tax computation, you will think, oh, 75,000, it is within 1 lakh, so therefore no tax. Then, oh, 1 lakh, this 1 lakh is on or after 23rd July 24. Oh, 1 lakh, it is within 1,25,000, no tax. Like this you should not do. This is not the way of doing it. This is a very common mistake that will happen from students. I'll tell you how you should think. These limits, 1,25,000, 1 lakh, these are all aggregate limits for the entire year. So for your 24-25 year, you will not even apply the 1 lakh limit. Whether before 23rd July or after 23rd July, you will not even apply the 1 lakh limit. You will apply the 1,25,000 limit. Now what's your total gain? Total gain is 1,75,000, which is more than 1,25,000, guys. So first of all, you have agreed that there will be taxation. First of all, there will be taxation because 1,75,000 is more than 1,25,000. What I am trying to communicate to you is that 1,25,000, look at it as aggregate annual limit. Don't apply 1 lakh limit and 1,25,000 limit. Instead, apply just the 1,25,000 limit. Total gains you will see, okay, it's more than 1,25,000, which means you've concluded that there is taxation. Now, how will you compute? See, after 23rd July, the tax rate is higher. It is 12.5%. Before 23rd July, the tax rate is lesser, 10%. So first I will try to give exemption here. Up to 1,25,000 is exempt. So 1 lakh, I'll say it's exempt over here, no tax. So how much more exemption am I left with? 25,000 exemption I am more left with. That 25,000 exemption I will give over here. So what is the balance gain I'm left with? 50,000. On that 50,000, before 23rd July 24, the tax rate is 10%. So your tax liability is going to be 5,000. Surcharge says and all, if applicable, as usual only. So the tax liability in this case on this capital gains will be 5,000. You understood what I did? First of all, I will not apply the 1 lakh limit. I will apply only 1,25,000 limit. That 1,25,000 limit will be aggregate limit for the entire year. Okay, the total is 1,75,000, which is more than 1,25,000. So I will conclude that yes, tax is applicable. Now, after 23rd July 24, tax rate is higher. So I will try to give exemption here first, obviously. So here I will give the 1 lakh exemption. I will still be left with 25,000 exemption. That I will share over here. So I will still be left with 50,000 taxable gains here. That 50,000 into 10% by 10%. Before 23rd July 24, the rate is 10%. So 50,000 into 10%, 5,000 will be the taxable number. This example would have given you perfect clarity about the implication of this amendment. Alright guys, so this was your amendment in 112A, that your exemption limit is not 1 lakh anymore, it is 1,25,000. Tax rate till 23rd July 24, before 23rd July 24 it is 10%, on or after 23rd July 24 it is 12.5%. And that 1,25,000 exemption, first I will exhaust on the transfers which happened on or after 23rd July 24, because here higher tax rate is there. The balance exemption only I will use for transfers which happened before 23rd July 24. Okay, so this was our entire discussion relating to section 112A. So I was telling you that all these 3 sections have been amended. 112A we have covered. In 112A, 1 lakh exemption has been increased to 1,25,000. Tax rate has been increased from 10% to 12.5%. Okay. As we learn the new amendments, don't keep forgetting the old provisions that we learned. So first of all, I told you over here, period of holding, only 2 we have, 12 months, 24 months. Then no indexation benefit. Then gift and will, not a transfer, only if assessee is individual HUF. And then 112A we learned. Okay, now come on everybody, let's come to section 112. Our next discussion is going to be section 112. If assessee is having LTCG, we first try to fit it under 112V, guys. If it doesn't fit under 112V, we put it under 112. Now, even in 112, just like how I taught you 112A, let's see what is the existing provision first. Then only we will see the amended provision. Okay. Existing provision, if you see, general tax rate is 20%, guys, and generally though you get indexation benefit, long term you get indexation benefit. So generally tax rate is 20%, but if it is listed securities and zero coupon bonds, you get two options, 10% without indexation or 20% with indexation. And if it is unlisted securities transferred by a non-resident or foreign company, then 10% is your tax rate without indexation and currency conversion. At the intermediate level, these two you would have seen very rarely. This is what you generally see in your questions. So section 112, general tax rate is 20% and you do get indexation benefit also. Listed securities and zero coupon bonds, two options, 10% without indexation, 10% with indexation. And for unlisted securities transferred by a non-resident or foreign company, here 10% will be your tax rate without indexing, without currency conversion also. Okay. This is your section 48 proviso 1, that one. Alright. Anyways, coming to the amended provision. This amendment will also apply only if the date of transfer is on or after 23rd July 24. What are the changes? General tax rate has been reduced from 20% to 12.5%. But however, no indexation benefit. See, what the government did is, in one side, government took away the indexation benefit, guys. Indexation is a benefit or a burden? It's a big benefit, right? Government took away this benefit. But on the other side, government rewarded us by reducing the tax rate. So, what they have done is, they've taken away the indexation benefit, but they've reduced the tax rate. So tax rate has been reduced from 20% to 12.5% and no indexation benefit. No, this whole provision of listed securities and zero coupon bonds, 10% with indexation, 10% without indexation, 20% with indexation, all this has been removed. Tax rate is 12.5% straightforward without indexation, story over. Now, for these unlisted securities, here also tax rate will remain 12.5% only, same thing without indexation, without currency conversion. That is very straightforward. Section 112, the tax rate is 12.5%. Whatever be the category, this category, this category, this category, everything has been changed to 12.5% and no indexation. Okay, but however, you remember I was telling you that there was a lot of news that indexation is restored. I am coming to that now. See, if assessee is a resident individual or resident HUF, and if long-term capital asset is immovable property, and if date of acquisition was before 23rd July 24 and date of transfer is on or after 23rd July 24, then you will do two calculations. 12.5% without indexation, 20% with indexation. Whichever is lesser, assessee will pay as tax. This will go slightly over your head, but we will discuss this patiently. Don't get up and go just because it's getting a little too much. Persist, stay and listen. The greatness is not in getting up and leaving. The greatness is, even when it gets difficult, still persisting and still paying attention. See, I'll explain this concept to you over here. What is your existing provision, guys, under 112? Your existing provision is general tax rate is 20% and you get indexation benefit also. And for listed securities and zero coupon bonds, you have two numbers, 10% without indexation, 20% with indexation. And for unlisted securities transferred by a non-resident, you have 10% taxation without indexation benefit and without currency conversion. Now all of this, if your date of transfer is on or after 23rd July 24, all of this has been changed to 12.5%. So if you notice, 112A also, the rate has been increased from 10% to 12.5%. 112 also, the rate has become 12.5%. So no 10%, 20% and all, 12.5%. Other provisions in section 112 remain the same, guys. Even over here, chapter 6A benefit you will not get. Even now, if assessee is having any unutilized BEL, you can adjust if assessee is a resident. Section 87A rebate you will still get. But however, earlier we were giving indexation benefit. Now, without indexation we computed, guys. Try to interconnect. Earlier we learned, no, 23rd July 24 onwards, no indexation. So we did not give indexation, but we reduced the tax rate to 12.5%. Till here, okay. When the government brought this provision, there was a hell lot of mess that was getting created. People started objecting against it. So therefore, what the finance minister did is, they gave us a provision. They said, listen assessee, okay fine. You are scared that no indexation benefit. Okay fine. You do one thing. You compute with indexation. You see what is your capital gain. On that 20% you calculate tax. Without indexation, you see how much is your capital gains. On that 12.5% you calculate tax. Whichever is lesser out of these two you pay. But this benefit we will not give for all assessees. This benefit we will give only if 4 conditions are fulfilled. Condition number 1, you should be a resident individual or resident HUF. Condition number 2, the long-term capital asset has to be an immovable property. Can be land, can be building, it has to be immovable property. Condition 3, the date of acquisition should be before 23rd July 24, and condition 4, obviously date of transfer is when, on or after 23rd July 24. If all of these 4 conditions are fulfilled, then only we will give you this benefit of doing both the calculations and finding whichever is lesser. But the point is, the real game that the finance minister played with us was that all this is written where? In section 112. Now 112 is a taxation section, right guys? It's not a capital gains computation section. It's a tax computation section. So when will you do all this? Only while computing tax. So which means, see, in 112A, what did I tell you? I told you in 112A, even if the capital gains, like in this case, okay, total capital gains is 1,75,000. So how much capital gain will form a part of the total income? Full 1,75,000 will form a part of the total income. You will think about the 1,25,000 exemption only when you compute tax. Same way, even in section 112, the LTCG number without indexation, that only will form part of total income, because the provision is no more indexation. So LTCG without indexation only will form part of the total income. All this calculation of 12.5% without indexation, 20% with indexation, all this will be discussed only while computing tax. Implication of this I will explain to you with the help of an example. Step by step we will go. So, I'll repeat section 112 again. Section 112, the provision is simple. Basically, if 112A is not applicable, then only we come to 112, guys. Earlier, the tax rate was 20%. For listed securities and zero coupon bonds, 10% without indexation, 20% with indexation. For unlisted securities transferred by non-residents or foreign companies, it was 10% without indexation and without currency conversion. Now, if the date of transfer is on or after 23rd July 24, your capital gains amount will be first of all calculated without indexation benefit. Only 2 periods of holding, 12 months and 24 months. Without indexation benefit, you will compute the capital gains and it will be taxed at the rate of 12.5%. However, if your assessee is a resident, individual or HUF, if long-term capital asset is immovable property, if date of acquisition is before 23rd July 24, if date of transfer is on or after 23rd July 24, then you will calculate both 12.5% without indexation, 20% with indexation, and out of these two, whichever is lesser is what your assessee will pay as tax. But all this calculation you will do only when you are computing tax, not when you are computing total income. See, look at this example, alright. When it came to the period of holding amendment, if you remember, I gave you the list of questions, you answered that and you got better clarity. Same thing happened in 112A. When I gave you the 1,75,000 question, you got better clarity. Same way, 112, right now you will be feeling pretty overwhelmed, thinking, oh my god, how will I understand this? How will I remember this? You listen to this one simple question, guys, all your doubts will be put to rest, okay? Listen to me. We will work this question out in two ways. First, what if the date of transfer is 1st July 24? Which means the date of transfer is before 23rd July 24. As per the existing provision, we will work this out first and then we will work it out as per the new amended provision. Okay, so in my example, the capital asset is immovable property. Date of acquisition is 1st Jan 2005 and period of holding is more than 24 months also, more than 36 months also. Full value consideration is 70 lakhs. Cost of acquisition is 10 lakhs. For the sake of easy discussion, indexed cost of acquisition, I have given the number 45 lakhs. Date of transfer is 1st July 24. Okay, so we have to compute capital gains. We also have to compute tax on capital gains. Okay, and so these are the two questions: capital gains on tax and tax on capital gains. Now, how do I generally ask you to compute capital gains? First, start with what is a capital asset transferred. Okay, it is immovable property. Then we see the period of holding, guys. Period of holding over here, when did we acquire? 1st Jan 2005. And when are we transferring? 1st July 2024. Now this period, now wait, I told you at this stage, you always pause, check, think. You check the date of transfer. Is it before 23rd July 24 or is it on or after 23rd July 24, guys? This is before 23rd July 24. So which provision you will apply? The existing provision only you will apply. No tension over here. So what is the existing provision? This period is definitely more than 12, 24, 36. It is more than 24 months. So therefore it becomes long-term capital asset. I will first try 112A. Of course, 112A will not apply because this is immovable property. So therefore, I will apply section 112, guys. Then I will start the computation of capital gains. So what is the full value consideration? It is given to us over here, 70 lakhs. I am going to do usual computation, what I know already, because date of transfer is before 23rd July 24. So like how I would generally calculate, normally like how I would calculate, same way I will calculate even over here. No expenses on transfer. This itself becomes a net consideration. So from this cost of acquisition, I will index the cost of acquisition because it is 112. It is not 112A. It is not depreciable asset. It is not slump sale. It is not bonds and debentures. So I will index the cost of acquisition. Come on, it is long term. I can index. So indexed cost of acquisition is 45 lakhs. So what is my net number, guys? 25 lakhs. This is going to be my LTCG. Okay, and what's going to be the tax on this LTCG? Even over here, even in this question also, I will assume that the other income of the assessee, is more than the basic exemption limit, which means I will assume that my assessee is not having any unutilized basic exemption limit. Okay, so assuming that there is no unutilized basic exemption limit, assuming that the basic exemption limit is fully adjusted against other incomes, so tax on this LTCG is going to be 25 lakhs into 20%. Existing provision, guys, 112, tax rate is 20%. Only for listed securities and zero coupon bonds, we get a choice, 10% without indexation or 20% with indexation. Only for unlisted securities transferred by non-resident, we say no indexation, no currency conversion. Otherwise, generally the rate is 20%. So therefore, 5 lakhs is going to be the tax on LTCG. Of course, we will have cess and all normal calculation. Okay, so what I've done over here is the existing computation as per the existing knowledge. Now let us redo the whole thing, guys, assuming that the date of transfer this time is after 23rd July 24. Let us say that the date of transfer now is 1st August 2024. Okay, now the whole game will change. You will enjoy this discussion. Listen to me. First part you understood properly. Existing calculation only I did over here. Now listen to this. Same way I will start, guys. Any capital gains question, same steps I will follow. I will start with capital asset transferred. Okay, capital asset transferred is immovable property. Then I will write the period of holding. We acquired this asset on 1st Jan 2005. We are transferring this asset on 1st August 24. At this stage, I will pause, check, think. I will look at the date of transfer. Is the date of transfer before 23rd July 24 or on or after 23rd July 24? It is on or after 23rd July 24. Therefore, I will have to apply the amended provision. Amended provision means 3 places there will be an attack. Place number 1, period of holding only 2 periods, guys. Place number 2, no indexation benefit, guys. And place number 3, tax calculation will change. 3 places will get attacked. So keep in mind, date of transfer here is on or after 23rd July 24. So full computation I'll have to do as per the new provision, as per the amended provision. Now this period, what's the relevant period of holding over here? More than 24 months, because it is new provision, only 2 periods of holding I have. It can't be 12 months because 12 months is only for listed securities, listed or unlisted units of UTI, listed or unlisted units of equity oriented mutual fund, and listed or unlisted zero coupon bonds. This is immovable property. Everything else is 24 months. It is more than 24 months, therefore it is long term capital asset. It can't be 112A, it is section 112. Okay, so with this, the first attack I have succeeded. Now let's continue. What is the next point? After this we start the computation, guys. How will you do the computation? We'll start normally. Full value consideration. The full value consideration is 70 lakhs. From this, cost of acquisition, no indexation, guys. It is long term. It is 112, but still on or after 23rd July 24, no indexation. So second point also I have applied. So I will take the number before indexation. So the cost of acquisition 10 lakhs only I will take. So therefore what is going to be my LTCG under section 112, guys? It's going to be 60 lakh rupees. So this is the number that will enter my total income computation. Did you notice? Here did I do that calculation? 20% with indexation, 12.5% without indexation, whichever is lesser. Did I do all that? No. In my capital gains computation, no indexation, story over. So my LTCG is 60 lakhs. Here LTCG was only 25 lakhs. Here LTCG is 60 lakhs. In my earlier situation, how much LTCG will form part of total income? When you're doing total income computation, this full 25 lakhs will form part of your total income, guys. Inside total income, LTCG under 112, you will put 25 lakhs. In this situation also, how much LTCG will form part of your total income, guys? The whole 60 lakhs will form part of your total income. And are you noticing this is more than 50 lakhs? So assessee will have surcharge also. Surcharge also you will compute. Alright. So with this you will do your total income computation and all. And even here I am assuming that the other income is more than BEL. So I am assuming that there is no unutilized BEL. Okay. Now question arises, how much will be your tax on LTCG? Let's do the tax computation. I am not able to compute the total income because we don't know how much is the other income. Other income is more than BEL, I have mentioned over here. But let's do the tax on LTCG part. Then I'll give you a number for other income also, and we'll do proper tax computation also, don't worry. So for now, let's compute the tax on LTCG. Now how will you compute? We discussed that under section 112, if 4 conditions are fulfilled, then you will get 2 options, right guys? Earlier, straight away 20% we used to do. Now the new tax rate is 12.5%. The new tax rate is 12.5%. But if 4 conditions are fulfilled, then tax rate, you have a different calculation. What are the 4 conditions? Condition 1, assessee has to be resident individual or HUF. Are you noticing all this? Am I thinking while computing capital gains? No. All this I am thinking only while computing the tax on capital gains. My capital gains computation is over. My capital gains that will form part of total income is 60 lakhs. This calculation is over. Right now I am calculating how much tax will form, right now I am calculating the tax on my capital gains number. Okay, so condition 1, yes, assessee is resident individual or HUF. Condition 2, yes, the long term capital asset is an immovable property. Condition 3, yes, the date of acquisition was before 23rd July 24, and yes, condition number 4, the date of transfer is on or after 23rd July 24. So all the 4 conditions are fulfilled, guys. If all the 4 conditions are fulfilled, what will we do? Our tax computation will be like this: 20% with indexation. With indexation we will compute the capital gains, 20% of that, or 12.5% without indexation, guys. Now see, without indexation we already have the number. It is 60 lakhs. So 60 lakhs into 12.5%, how much will this be? 60 lakhs into 12.5%, this is going to be 7,50,000 rupees, or we will calculate 20% with indexation. With indexation, we've already calculated the capital gains. If I index the cost of acquisition, my capital gains is 25 lakhs. So 25 lakhs into 20% will be how much? 25 lakhs into 20%. This is going to be, oh yes, obviously 5 lakhs. Now out of this, which is lesser? 5 lakhs is lesser. This is what my assessee will pay as tax. Understood, everybody? So how much of the income will form part of your total income? Here are you doing with indexation, without indexation, whichever is lesser? No. Now you understood. At this stage, no indexation allowed, guys. That's all. No indexation. Story over. So 60 lakhs is what will form part of your income. But when you're doing tax calculation, as per the new provision, tax calculation 112, tax rate is 12.5%. But however, if all these 4 conditions are fulfilled, then the tax rate will be 20% with indexation or 12.5% without indexation, whichever is lesser. Here 5 lakh is lesser. This is what my assessee will pay on this LTCG. Now I am hoping you are having a much better clarity. Now whatever confusion was there with respect to 112, it should have all fallen in place. Perfect. Now let's continue the same question, guys. Let's get a little better clarity. So what have we computed? We have computed LTCG under section 112 is how much? 60 lakhs, right? Yeah. We calculated 60 lakhs. And let us say IFOS, normal rate IFOS of the assessee is 5 lakhs. Okay. So which I know chapter 6A, let us say. So the total income of the assessee is 65 lakhs. Okay. Now the question is how to compute tax on total income. This 65 lakhs, first you will split into 2 parts, guys. Normal rate and special rate, section 112. Normal rate you have 5 lakhs and section 112 you are having 60 lakhs. Now on this 112 you've already calculated tax, guys. How did you calculate? 112, generally the tax rate is 12.5%, but however all my 4 conditions were fulfilled, so I did 20% with indexation, 12.5% without indexation, whichever is lesser was the taxable, was a tax liability. So 5 lakhs is the lesser amount. So on this 60 lakhs, 5 lakhs is the tax I've concluded. On this normal rate, how will you compute tax? Nothing is mentioned in the question. So let's say my assessee is following 115 BAC. By default, the assessee is following 115 BAC only, no. So income up to 3 lakh, no tax. 3 lakh to 7 lakh, you have 5% tax. Income is 5 lakhs. So 3 lakh to 5 lakhs, on that 2 lakhs, you will ask the assessee to pay 5% tax, slab rate, guys. So this is going to be how much? 10,000 rupees. So now if you see, the total basic tax of the assessee will be 5,10,000. Then you will think about 87A rebate. No 87A rebate because total income is more than 7 lakhs. Then you will think about surcharge. Will you have surcharge? Yes, you will have surcharge because your total income is more than 50 lakhs, guys. Because total income is more than 50 lakh, you will have surcharge. Surcharge will be at what rate? At the rate of 10% over here, because more than 50 lakh up to 1 crore, 10%, right? And one more thing you remember learning, 112, 112A, dividend income. On these incomes, maximum surcharge rate is 15%. But here I am applying 10% only, 10% of your tax amount. So 10% of 5,10,000 will be 51,000, no marginal relief. So straight away you will add cess. This is going to be your tax liability. The reason why I did this calculation is to show you that which LTCG number is forming part of your total income. The number which you calculated without indexation, this is only forming part of your total income. You're understanding the smartness of the finance minister, guys. Had she said you can take whichever is lesser over here, then which 5 lakh is your tax liability you're choosing? No, this is on the basis of 25 lakhs capital gains. So you would have had you taken 25 lakhs LTCG over here, your total would have been less than 50 lakhs. No surcharge you would have had to pay. So you're getting the whole point. So all this thinking I'm not letting you do while computing LTCG. So therefore, for the purpose of total income, for the purpose of surcharge, for the purpose of setting off of losses and all, which capital gains number you will take? This 60 lakh only, which is without indexation, this number only will form part of your total income calculation. Getting it? Only while doing tax computation I am letting you do this. Had I let you do this thinking in your capital gains calculation itself, it would have been much more beneficial for the assessee, because then in that case I would have seen, okay, 5 lakhs is lesser. So 5 lakhs capital gains is 25 lakhs. So 25 lakhs only I would have put into my total income. So in that case my total income would have been only 30 lakhs. It would have been within 50 lakhs. I wouldn't have paid any surcharge. But I am not allowed to do that thinking in my capital gains calculation. I am allowed to do this thinking only while doing tax computation. Now I think the point I wanted to convey to you, I've actually conveyed. So guys, can we summarize all the discussions under capital gains that we've had till now, guys? With this, the most complicated amendment we've completed. Rest is all very straightforward. So what are the things we've concluded? See, we said that if the date of transfer happens to be on or after 23rd July 24, hereafter we will pause, check and think. We will check if the date of transfer is on or after 23rd July 24, then 3 things will get affected. Period of holding, only 2 periods we will have, 12 months and 24 months. We will not give any indexation benefit. And also your tax computation will change. Now how will the tax computation change, guys? If section 112A is applicable, then your LTCG in excess of 1,25,000 will be taxed at the rate of 12.5%. Now try to recall the example I gave you over here. 1,25,000 will be entire year limit. If total LTCG under 112 is more than 1,25,000, then you will give this exemption first to capital gain which is earned after 23rd July 24. You remember the example, guys? I'll put the same example for you over here once again. I had 2 transfers, guys. On 1st May 24, I had a transfer. My capital gain was 75,000. Then I had a transfer on 1st October 24 also. Here my capital gain was 1 lakh rupees. So what did we do? This 1,25,000 exemption I will first enjoy on the transfer which happened after 23rd July, because here higher rate I have 12.5%. Before 23rd July to only 10%. So I will enjoy this 1,25,000 first against this number. So fully exempt. I still have 25,000 exemption left, which I will enjoy over here. So I am still left with 50,000 gain on that 10%. So 5,000 will be my tax liability. So this was section 112A. Then we learnt under section 112, what will you do, guys? Under 112, your tax rate is going to be 12.5%. But I gave you 4 conditions. If all the 4 conditions are fulfilled, then the tax rate is going to be 20% with indexation or 12.5% without indexation, whichever is lesser. But the main point is, all this calculation you will do only while computing tax and not while computing capital gains. While computing capital gains, my answer will be the same only. What happened? 1 minute. Okay, I'm guessing it's visible now. So I was telling you that if all the 4 conditions are fulfilled, 20% with indexation, 12.5% without indexation, whichever is lesser. But all this thinking you will do only when you're computing tax and not when you're computing capital gains. When you're computing capital gains, you will simply compute without indexation. Whether 112A, whether 112, no indexation if date of transfer is on or after 23rd July 24. Okay everybody, with this we are done discussing with these 2 sections. Now what is the only section we are left with? We are left with section 111A. Are you ready for that? Yes, proceed with 111A only if you're thorough till here. I am hoping the question and the example which I gave you over here, this would have made things a little better for you, at least with respect to 112. When I'm doing my capital gains computation, I will not think about the indexation. But when I'm doing the tax computation, if all the 4 conditions are fulfilled, then I will see whichever is lesser. This is the tax liability which I will have to pay. Okay, now come on everybody, let's come back to our handout over here. So under the LTCG taxation, I was telling you that we have changes in 3 sections, 112A and 112 we have learned. Let's talk about section 111A. Now what does section 111A say and when does 111A apply? See, whenever you have STCG, you first try to fit it under 111A, right guys? 111A applies if the security happens to be listed equity shares or listed units of equity oriented mutual fund or listed units of business trust, where STT you must have paid at the time of transfer. So over here the tax rate is 15%, right? But if your date of transfer is on or after 23rd July 24, then your tax rate becomes 20%. Simple as that. It is short term guys, anyways indexation is not possible over here. So here the only change is we are increasing the tax rate from 15% to 20%. So if I have to come back to my summary over here, if the date of transfer is on or after 23rd July 24, period of holding only 12 months and 24 months, no indexation, anyways no indexation because it is short term. While computing tax under 111A, tax rate they have increased from 15% to 20%. That's all. Only one change only in 111A. The rest of it all remains the same guys. Even now, you can enjoy 87A rebate against 111A, no chapter 6A, unutilized BEL you can avail if assessee is a resident. So everything else remains the same. Only thing, tax rate is changed from 15% to 20%. Okay. Then coming to the next amendment, section 50AA. 50AA was existing even earlier. 50AA used to say that market linked debentures and units of debt oriented mutual fund, I don't care about the period of holding, it will always be short term only. See, same way even depreciable assets WDV basis, irrespective of the period of holding, always short term only. Similarly, self generated intangible assets, even that we used to learn, right, that even over here, irrespective of period of holding, always short term only. Same way, even market linked debentures and units of debt oriented mutual fund were always considered to be short term only, irrespective of the period of holding. Now they've made another amendment in section 50AA. They have added 2 more points guys. Unlisted debentures transferred on or after 23rd July 24, unlisted bonds transferred on or after 23rd July 24. These two, irrespective of the period of holding, they will always be considered as short term only. So, if I have to come back to this list which I had given to you over here, for unlisted debentures, if they are transferred before 23rd July 24, I will apply 36 months. 36 months will be the relevant period of holding. But if the same unlisted debentures is transferred on or after 23rd July 24, the period of holding becomes irrelevant guys. What is a period of holding? I don't care about it. Irrespective of the period of holding, it will always be considered as short term only. market linked debentures, units of debt oriented mutual funds, unlisted debentures, unlisted bonds. If they are transferred on or after 23rd July 24, irrespective of the period of holding, they will always be considered as short term only. Market linked debentures and units of debt oriented mutual fund, this is existing provision. 23rd July 24, that provision will apply only for unlisted debentures and unlisted bonds. Okay, unlisted debentures, unlisted bonds, earlier they used to fit under 36 months period of holding. If they are held, if the period of holding is up to 36 months, then they are going to be short term. If the period of holding is more than 36 months, then they are going to be long term. But now I don't care about the period of holding, I will always consider them as short term only. Okay, this was section 50AA, and now coming to the last amendment in our capital gains discussion, which is about buyback of securities, section 46 capital A. So until now in our capital gains discussion, we spoke about period of holding. This provision, this amendment is applicable only from 23rd July 24. Period of holding, indexation and taxation. These three amendments are from 23rd July 24 only. But gift or will be considered as not a transfer. If assessee is individual or HUF, this is for the entire year. And then we spoke about just now 50AA. This is also 23rd July 24 onwards only. But buyback of securities, this entire section 46A has been amended, guys, but this amendment is from 1st October 2024 onwards. Okay, so we'll have to see what is the date of buyback. If the date of buyback is before 1st October 24, we'll have to apply the existing provision. Only if the buyback date is on or after 1st October 24, only then I will apply the amended provision. Okay, so we'll have to remember both the old provision as well as the new provision. Let me start discussing this with you. Let me help you understand. See, what was the existing provision? Existing provision also, new provision also, we have two sets of provisions for shares of domestic companies and other securities. See, the existing provision was if the shares of domestic companies are being bought back, okay, then for company has to pay additional income tax, which we used to call as buyback distribution tax 20%, surcharge 12% and 4% cess. For the security holder, there was no tax implication. But if other than shares of domestic company, if any other security is being bought back, for company there was no tax implication. For security holder there used to be capital gains, normal capital gains computation. Now what they've done is, this part remains the same. For domestic company shares, they've abolished this buyback distribution tax. This additional income tax, this buyback distribution tax and all, they've abolished. Instead, they've brought back the taxation on the security holder. This entire thing we will discuss with the help of a computation question with numbers only. You will understand this better. Let's listen to me. I'll take you to my classroom notes over here. Look at this example. Now I'm going to work this question out with you in two ways. First, what if the buyback happened on 1st July 24, that is before 1st October 2024, and then what if the buyback happened on 1st October 24, that is on or after 1st October 2024. This way you will get an idea about both the old provision and the new provision. See, the amendment is only when the buyback is of shares of domestic companies. If other than shares of domestic companies, if any other security is being bought back, then there is no change. If any other security is bought back, for the company there will be no tax implications. For the shareholder, normal capital gains computation is going to be there. The whole change is only if shares of a domestic company is being bought back. Now listen, what was the existing provision? In the existing provision, if you see, there was no tax implication for the shareholder. The tax implication was only for the company. Like the company in my example issued 10,000 shares at 15 rupees each. Face value was 10. So company issued at a premium of 5 rupees on 1st December 2020. Company bought back 1 share out of every 10 shares at 60 rupees per share. So 60 rupees becomes a buyback price. Company is buying back on 1st July 24. Now Mr. A, he had bought 100 shares of the company at 20 rupees. He bought on 1st May 2021. This is my situation. Company issued 10,000 shares long back at 15 rupees. Mr. A bought 100 shares from the stock market at 20 rupees, let's say, on 1st May 21. Company is buying back 1 in every 10 shares at 60 rupees. 60 rupees is a buyback price. And let's say these are shares of domestic company. So my existing provision was for the company. there is a tax implication. For the company, my first step used to be, I would find the distributed income first. Now, distributed income is nothing but, think from the company's point of view, what is the buyback price? That is, what is the price which the company is paying now, minus what is the issue price when the company had issued the shares, how much the company received, that is the issue price, and now when the company is buying back, how much is the company going to pay? So, buyback price is 60 rupees. Issue price is 15 rupees. So what is this difference, guys? This difference is 45 rupees. This 45 rupees is first of all called as the distributed income. Okay. Then I will find the total distributed income, because this 45 rupees is distributed income per share. So what is total distributed income for all the shares? Totally the company is having 10,000 shares. If the out of every 10 shares held, company is buying back 1 share. So there are total 10,000 shares in the company. So how many shares is the company going to buy back, guys? 10,000 divided by 10. Totally 1,000 shares are going to be bought back by the company. So these 1,000 shares into rupees 45, the total distributed income is going to be 45,000 rupees. Alright, now on this total distributed income only, the company is supposed to pay something called as additional income tax, which we very popularly call as buyback distribution tax also. This additional income tax is 20%. So the distributed income is 45,000. No, this into 20%, which is going to be 9,000 rupees. Then company has to pay mandatory surcharge at the rate of 12%. Surcharge at the rate of 12% of this 9,000. So 9,000 into 12%, which will be 108. It will be 1080. So total is 10,080. On this, the company will have to pay 4% cess. So 10,080 into plus 4% cess. So into 1.04 would be 10483. So this is how much the company will have to pay as additional income tax, of course after rounding off. This was your existing provision. Existing provision, the same provision will continue to apply if buybacks are happening before 1st October 2024. From the company's point of view, we will see what is the distributed income, nothing but buyback price minus issue price. That difference into total number of shares bought back will give you the total distributed income. This into 20% will give you the additional income tax plus 12% surcharge plus 4% cess. Alright, so this was your existing provision, and this is from the company's point of view. And what about the shareholders' point of view? Now if you see in my example, my assessee is, my shareholder is Mr. A. He had bought 100 shares. So from his point of view, if you see, 10 shares company will buy back. 10 shares company will buy back at 60 rupees per share for him. So for him, there is going to be absolutely no tax implication. If you see, he is making a benefit, guys. He is making a gain. He paid only 20 rupees per share, but he is going to get 60 rupees per share for 10 shares he is going to get. So he did make a gain of 40 rupees per share for 10 shares. But from the shareholders' point of view, there was no tax implications, and this was as per section 46A. This was your existing provision. Now coming to your new provision, your amended provision. Amended provision says, say I've taken the same data, okay, only thing I've changed the date of transfer, I've changed the buyback date to 1st October 24. So if the buyback date is 1st October 2024 onwards, then in that case, for the company, there's going to be no tax implication. Basically, they are abolishing the additional income tax concept, okay. Instead, for the shareholder, there will be tax implication, guys, and for the shareholder, there will be two tax implications. One tax implication will be under the IFOS head, and the other tax implication will be under the capital gains head, and I will talk about one more tax implication from the TDS point of view also. Okay, now under IFOS, you must have learnt about dividend 222 A, B, C, D, E, you must have learnt. There they've added one more clause, 222F. Okay, so whatever is the buyback price which your assessee is receiving, how much he is receiving, guys, 60 rupees per share he is receiving. Think from Mr. A's point of view, 100 shares he is having. In 1:10 ratio, company is buying back shares. So 10 shares of his company is buying back. So total how much buyback price he is going to get? 60 rupees per share for 10 shares, totally 600 rupees he is going to get. This 600 rupees is going to be taxed for him under the IFOS head, and against the 600 rupees, no expenses will be allowed, guys. No expenses will be allowed. See, you must have learned, no, against dividend income, only one expense is allowed, interest expense. That too, maximum 20% of dividend income is allowed. Even that is not going to be allowed against 222F. Against 222F, no expense is going to be allowed. Whatever is a buyback price my assessee is going to receive. In my example, 60 rupees per share for 10 shares, total 600 rupees assessee is going to receive. This entire 600 rupees is going to be deemed to be dividend under 222F, and it will be taxed under the IFOS head. Okay. Then under TDS, you must have learned about section 194, guys. Under section 194, company is the deductor, right? Company deducts tax at the rate of 10% on whatever dividend the company pays, dividend under section 222 ABCDE. There they have added that section 194 dividend will, section 194 TDS will apply. That is, company has to deduct tax at 10%, not only on section 222A, B, C, D and E, but now also on 222F. So on this 600 rupees, there will be TDS under section 194 also. In section 194, you must have learnt like this, that if the mode of payment of the dividend is cash, irrespective of the amount, 10% TDS will apply. But if the mode of payment is non-cash mode, then up to 5,000 there will be no TDS. If it is more than 5,000, then 10% TDS will apply. That same provision will apply even over here. Basically, section 194, we are adding 222F also. Okay. Then comes my next point of view, next point from the shareholders' point of view, capital gains. See, in capital gains, if you see, these 10 shares which are being bought back by the company from Mr. A, we will treat as if there is an extinguishment of these 10 shares. Extinguishment is considered as a transfer, guys. So because there is a transfer, there will be capital gains computation. But we will treat as if full value consideration is 0. Why? Because we've already taxed the 600 rupees under IFOS. So it will be unfair if it is again considered in capital gains. So full value consideration will be taken as 0 minus the cost of acquisition. What is the cost of acquisition? Check now. The cost of acquisition for this assessee for 10 shares, he bought these 10 shares at 20 rupees per share. So 10 shares into 20 rupees per share, that is, this 200 rupees will be considered as his cost of acquisition. So he will have a 200 rupees of capital loss. Getting my point? So from the shareholders' point of view, IFOS 222F, whatever buyback price he is receiving, fully it will be taxed under 222F. From the capital gains point of view, it's as if the 10 shares are extinguished, because we know very well, right? Even in section 68 in your Companies Act, you must have learned that once the shares are bought back, they are extinguished. So from the shareholders' point of view, from Mr. A's point of view, those 10 shares are not existing anymore. So the 10 shares are extinguished. So there is going to be a transfer. So because of this transfer, there will be capital gains computation. But full value consideration, I can't put the 600 again over here because I've already taxed it. So full value consideration will be considered as 0. Then whatever my assessee had paid to acquire these shares, and my assessee had paid 20 rupees per share. No, I am considering only for 10 shares because only 10 shares are extinguished. So I am doing capital gains computation only for these 10 shares. So these 10 shares into 20 rupees per share, this will be considered as cost of acquisition, and there will be a loss number only. Every time there will be a loss number only, and you will treat it like any other capital loss. If it is LTCL, you will set it off only against LTCG. If it is STCL, you can set it off against LTCG or STCG, and it will be carried forward for 8 years. Okay guys, now when did the extinguish happen? See, the extinguish happened whenever the buyback happened. So on 1st October 2024, the extinguishment has happened. Now this is the date of transfer. Same thing guys, the date of transfer, if you see, is on or after 23rd July 24. So because the date of transfer is on or after 23rd July 24, three things. Period of holding, I will consider only two periods, 12 months, 24 months. These, if they are listed, the period of holding will be 12 months. If they are unlisted, the period of holding will be will be 24 months over here. So it's definitely more than 12 months, more than 24 months, therefore long term. Then no indexation. So even if it is long term, here if you see clearly it is long term, guys. Mr. A bought the shares on 1st May 21, but buyback is happening only on 1st October 24. Definitely it is long term, but I will not index the cost of acquisition, because if the date of transfer is on or after 23rd July 24, I am not allowed to index. So no indexation of cost of acquisition also. So this in my example is going to be a long term capital loss of 200 rupees. LTCL can be set off only against LTCG, can be carried forward for 8 years. You understood what I did over here? I basically combined the amendments. For capital gains computation, so I will apply 23rd July 24 date only, no. Buyback is happening, yes. Buyback is happening on or after 1st October 24. So therefore for company, no tax implication. Whatever tax implication is for the shareholder only. For shareholder, if you see, IFOS, whatever buyback price he is receiving is taxed under IFOS. Under capital gains, he will have a capital loss only. Whatever he spent to buy the shares will become his capital loss. Here it is long term capital loss, because period of holding is definitely more than 12 months, 24 months. So definitely long term capital loss. Okay everybody, and I covered section 194 amendment also over here. 194 amendment will anyways come later as well. In section 194 only 222 ABCDE was written. Now they have added 222F also. So even dividend under 222F also, TDS under section 194 at 10% will apply. Okay, so that is it. Now with this we've completed all our amendments from the capital gains discussion. Now see, have a look at this summary. So what I've done is, we've completed all our capital gains amendments. Now all of the amendments that we spent so much time to discuss, I'm going to summarize all of these amendments in this 1.5 pages. It will give you perfect clarity. With this, there will be absolutely no confusion even left. See, the first thing, if the date of transfer is on or after 23rd July 24, three things will get affected. Period of holding, no indexation and taxation. Period of holding, only 12 months and 24 months you will have. You will not have 36 months. You will not get indexation benefit, and taxation will change. Taxation, if it is long term, I will first try 112A, then only I will try 112. 112A existing provision is 10% if LTCG is more than 1 lakh. My amended provision will be 12.5% if the LTCG is more than 1,25,000. Then 112, my existing provision is 20%, but this will change to 12.5%. But however, if the 4 conditions are fulfilled, then the tax rate will be 20% with indexation or 12.5% without indexation, whichever is lesser. If it is short-term capital gains, triple money existing tax rate is 15%. This will change to 20%. If triple money is not applicable, slab rate taxation will apply. That will remain the same. Then we learned, if there is a transfer by way of gift or will, it will not be considered as transfer only if assessee is individual or HUF. Then we learnt about buyback of shares. If the buyback of shares is happening before 1st October 2024, then company will have to pay additional income tax at the rate of 20%, surcharge at the rate of 12% and cess at the rate of 4%, and for the shareholder there will be no tax implication. But however, if the buyback is happening after 1st October 24, for the company there will be no tax implication. Instead, for the shareholder, whatever is the buyback price that he is receiving, it will be taxed under IFOS under the section 222F. Then under capital gains, it will be treated as if there is an extinguishment of asset. Full value consideration will be 0. Cost of acquisition you will have to subtract. Of course, you can't index the cost of acquisition because a transfer is happening after 1st October 24. So you will get a negative number only, and this negative number will be considered as capital loss. You will treat this capital loss, if it's long term, you will treat it like any other long term capital loss. If it is short term, you will treat it like any other short-term capital loss. But no indexing this cost of acquisition because the transfer has happened after 1st October 2024. So anyways, no indexation is possible. Okay everybody, so with this we've completed our entire capital gains discussion. I think I've put in my 200%, especially with the examples you must have understood very nicely. With this, I'll close my capital gains discussion and I'll take you back to my handout. Let's come to our next head of income now, IFOS. Under IFOS, we have two small amendments, guys. One is in family pension and the other is in section 56 to 7B. Both are extremely simple. 1 minute, it will get done. Family pension, what is your existing provision? Whether assessee is following normal, whether 115 BAC, common provision you have, guys. Family pension is taxed under the head IFOS. And how much deduction do you get? 33.33% of the pension income, or 15,000, whichever is lesser. This is the deduction you get. Now the same deduction will continue under the normal regime. But if assessee is following 115 BAC, instead of 15,000, it will become 25,000. Got it? Very simple. As per the amended provision, if assessee is following the normal regime, there is no change. But if assessee is following 115 BAC, instead of 15,000, the number will change to 25,000. Then in IFOS, you must have learnt about section 56 to 7B, guys. You must have learnt if the company is a closely held company and if it has issued shares in such a way that it is above face value, also above fair market value. Then in that case, the difference between the issue price and the fair market value will be taxed under the head IFOS for the company, what we used to call as the angel tax, guys. Now this existing provision which we've learnt under 56 to 7B, this has been discontinued from your previous year 24-25 onwards. So this provision you don't have to learn anymore. Okay. So I hope you recall. Closely held company, issue price is more than face value, also more than FMV. Then the difference between issue price and FMV, we used to tax under the head IFOS. This provision is discontinued. Okay, that's all. IFOS 2 points, family pension and 56 to 7B. Now chapter 6A, ATCCD subsection 2 was changed. I already discussed this with you even earlier. ATCCD subsection 2 is a section which is allowed under the normal regime also, 115 BAC also. See, if assessee is following 115 BAC, generally I take the whole chapter 6A, open the dustbin and dump it into the dustbin. But however, 115 BAC, 3 sections assessee can still enjoy under chapter 6A. One is section 80 JJAA, the other is section 80 CCD subsection 2 and the last is section 80 CCH subsection 2, guys. Now in chapter 6A, the amendment is in section 80 CCD subsection 2 if assessee is following 115 BAC. If assessee is following the normal regime, there is no change. You will get 14% of salary maximum deduction if employer is central government, state government, otherwise 10% of salary. But in 115 BAC, employer's contribution to NPS, employee will get 14% of salary as maximum deduction irrespective of who the employer is, whether central government, state government or any other employer, doesn't matter. If assessee is following 115 BAC, employer's contribution to NPS, assessee will get a deduction under ATCCD subsection 2, maximum 14% of salary. I already discussed this with you along with our PGBP discussion. There also I discussed this with you in full depth. Simple provision. In normal regime, no change. Here still you have two numbers, 14% and 10%. Only in 115 BAC, irrespective of who the employer is, the maximum limit is going to be 14% of salary. Okay. Then coming to our TDS and TCS chapter, here we have a few amendments but very simple amendments. I'll explain them to you one by one. First of all, under section 192. See, under section 192, tell me, how does your employer generally compute TDS, guys? Employer will compute the total income of the assessee. To compute the total income of the employee can inform to the employer what are his other incomes. Like employee can tell the employer, I earned so much bank interest or I earned so much rental income. He can inform other income to the employer, but he should not inform about losses to the employer. But one loss he can still inform, which is loss from house property. We've learned all this, guys. All these provisions remain the same. So on the basis of all this information, on the basis of how much salary employer is giving to the employee, on the basis of this other income information which employee has given to the employer, on all this basis, employer will compute the total income of the employee. On this total income, tax the employer will compute. From this tax, TDS credit will be given for whatever TDS has been deducted by others against the employee. So which means employee can inform the employer about his TDS credit also, and whatever is a balance amount, this is what the employer will deduct under section 192 as TDS. This was your existing provision. So existing provision spoke only about TDS credit. In the existing provision, the employee can inform the employer what are his other incomes and what is his loss from house property and how much TDS credit is he having. But in the existing provision, TCS credit was not written. That is what the amendment is. The amendment is very simple, that the employee can inform the employer how much TCS credit he is having. So now if you see, as per the amended provision, the employee will inform the employer how much TCS credit he is having. So the employer will deduct TDS credit and TCS credit, and whatever is the balance, only this he will deduct under section 192. Simple point guys, TDS credit employee was anyways informing the employer earlier. Now employee can inform the employer about his TCS credit also. Simple point, section 192. Then under section 193, TDS on interest on securities, 10% TDS guys on interest on securities other than government securities. Now here there is an amendment. Earlier the provision was like this: 8% savings taxable bonds 2003, 7.75% savings taxable bonds 2018. For these two bonds, for these two securities, if the interest was more than 10,000, only then section 193 TDS was applicable. Now, as per the amended provision, which is applicable with effect from 1st October 24, let me tell you, capital gains chapter, most of the amendments from 23rd July 24, only buyback was 1st October 2024. TDS TCS chapter, the amendments are with effect from 1st October 2024. So, under section 193, they've added one more point in this 10,000 criteria. We already had 8% savings bond 2003, 7.75% savings bond 2018. Now they've added floating rate saving bonds 2020. If the assessee is getting interest in any of these, section 193 TDS will apply only if the interest is more than 10,000. So from these bonds, if assessee is going to get interest before 1st October 2024, you will not apply the 10,000 limit. Irrespective of the amount, section 193 TDS will be deducted at 10%. But if interest on these bonds your assessee is getting on or after 1st October 24, then only you will see how much is the interest. Is it within 10,000 or more than 10,000? If it is more than 10,000, then only section 193 TDS will apply. Simple point guys. So earlier this 10,000 limit was only for two securities. Now 1st October 2024 onwards, the same 10,000 limit is for three securities. 8% savings bond, 7.75% savings bond and floating rate savings bond 2020. Okay, then section 194 amendment, I've already discussed this with you. Under section 194 TDS on dividends, earlier TDS on dividend was deducted under 222 ABCDE dividend. If any of these dividends the company is paying, deductor is a company will deduct tax at the rate of 10%. But here 222F also they have added. What is 222F? Just now we learnt, whatever buyback price is given to the shareholder that is deemed to be dividend under 222F. So on that also section 194 TDS will apply. So 194 TDS, which is applicable on dividend, will apply on all the 6 dividends now. Okay. And of course, this is also with effect from 1st October 24, obviously because this section itself is applicable 1st October 24 onwards. Okay. Then comes our 194C. 194C, which talks about TDS on payment to contractors, your works contract service. Now in section 194C, if you see, the meaning of works contract is given. The meaning, what does works contract include and what does it exclude? So what does it include? It remains the same guys. Remember how I taught you this A, B, C and one important point? That remains the same. A for advertising, B for broadcasting and telecasting, C for carriage, C for catering. An important point, remember, supplying material to the jobs, supplying material to the job work contractor and telling him to make goods according to our specifications. So we are giving to him two things. We are giving him material and we are giving him specifications. So all of this will come under works contract. No change over here. What does works contract exclude? If I give the job worker only specifications, but if I don't give him material, that will not be considered as works contract. That point remains the same. Here they've added one more point. If a sum is fitting under 194J, then don't put it under 194C. So because of this point, hereafter we will always give the sequence rule like this. We will first try 194J. Only if 194J is not applicable, only then we will put it under 194C. So the thing is, people were using the wrong section numbers. So that is what the income tax department is trying to avoid. They are saying that if something comes under 194J, then please don't put it under 194C. Okay. So we have to first try checking if the transaction fits under 194J. If it doesn't fit under 194J, only then we put it under 194C. Okay. So this was your 4th amendment in your TDS chapter. Now comes the 5th amendment. In TDS chapter, in my opinion, this is the most important amendment. Everything else is very simple. Everything else you look at it once, you will understand. But this is the most important amendment in your TDS chapter 194IA. I am going to explain this to you straight away in our classroom notes. Listen to me. First of all, what does section 194IA say? This section applies whenever an assessee buys immovable property, guys. Let's say there are two people in the story. We have the buyer and we have the seller. Okay, the seller has sold to the buyer some immovable property. This immovable property should not be rural agricultural land. Also, this transfer should not be by way of compulsory acquisition. Right, guys? Now, to this seller, the buyer is going to pay consideration. So, what have we learnt in section 194IA? We will see what is a consideration. Consideration or SDV. Out of these two numbers, we will see whichever is a higher. If this higher number is at least 50 lakhs, then in that case, 194IA TDS will apply at the rate of 1%. This is what we generally see under 194IA. Now, a confusion arises where, what if on this side we have two parties? We have buyer A, buyer B. They are jointly buying this property. Then how will you compute the consideration number? Let us say buyer A is going to pay 30 lakhs, buyer B is going to pay 30 lakhs. So will you say, oh, 30 lakhs, it is less than 50 lakhs, so no 194IA? Will you say like that, or will you look at the aggregate 60 lakhs? Similarly, there is a possibility the seller may be joint seller. We may have joint seller X, joint seller Y. Total consideration is 60 lakhs, X will get 30 lakhs and Y will get 30 lakhs. So there is a possibility of having joint buyer or joint seller. So in this situation, are we supposed to look at the consideration per buyer per seller, or are we supposed to look at the aggregate consideration? About this, a confusion was existing for a very long time. That confusion has been set to rest. The Income Tax Act has been amended. 194IA very clearly says now we are supposed to look at the aggregate consideration number. Whether there are joint buyers, joint sellers, I don't care. For this property, what is the total consideration? 60 lakhs. This 60 lakhs is at least 50 lakhs. Welcome to 194IA. Understanding per buyer, per seller, what is the amount? We will not bother about that. Instead, we will see the total aggregate consideration. Is the aggregate consideration at least 50 lakhs? Yes, it is at least 50 lakhs. Hence, 194IA TDS will apply. Story over. Okay, so coming back to my handout, 194IA, look at this point, guys, and be aware, until now all the amendments in TDS we learned, everything was applicable 1st October 2024 onwards only. So 1st October 2024 onwards, if there are multiple transferors or multiple transferees, consideration shall be aggregate. Keyword will be aggregate. Consideration will be the aggregate of the amounts payable by all transferees to all transferors. Same example I have put for you here as well. You can read it later. Alright, so this is it with our entire discussion relating to section 194IA. Point is, we are supposed to look at the aggregate consideration and not the consideration per buyer or per seller. Apart from this, there is a change in TDS rates in 5 sections. Of course, this change is also applicable 1st October 2024 onwards. So you will have to see when did the transaction happen. If the transaction happened before 1st October 24, the old rates will apply. If the transaction happened 1st October 24 onwards, the new rates will apply. Section 194G, TDS on lottery tickets, gambling and all that. 194G, TDS on commission on sale of lottery tickets. Existing provision was 5%. It has been reduced to 2%. 194H, if commission is not getting covered in 194D or 194G, we put it under 194H. Even that has been reduced from 5% to 2%. 194DA, if you are receiving any money from life insurance policy which is taxable, remember at least 1 lakh, then the TDS rate was 5%. That also has been reduced to 2%. 194IB, TDS on rent which is not covered by 194I. Remember, in this section we deduct tax only in the last month, either in the last month of tenancy or in the March month. So even that has been reduced from 5% to 2%. And lastly, section 194M, TDS on payments like works contract payments or commission payments or professional fees. If it is not getting covered by 194CHJ, it will get covered in 194M, guys. Works contract payment, your professional fees payment and your commission payments, if not covered by 194CHJ, it will get covered by 194M. Here also the tax rate was 5%. It has been reduced to 2%. So we have 5 sections. In all these 5 sections, from 5% it has been reduced to 2% with effect from 1st October 2024. 194G, 194H, 194DA, 194IB and 194M. Okay. Then coming to the next point, interest on late payment of TDS and TCS. See, earlier if you pay TDS late, basically you're supposed to remit TDS by 7th of the next month. So if you remit TDS late, interest applicable was 1.5% per month or part thereof. But if you remit TCS late, the interest was 1%. So there was no equality. So to bring equality, to bring parity, they've said for TDS also 1.5%, for TCS also 1.5%. So in both now, if you remit the TDS or the TCS late, then the interest rate will be 1.5% for TDS and for TCS. Earlier for TDS it was 1.5%, for TCS it was 1%. But now for both it has become 1.5%. Whether TDS, whether TCS. If you remit it late, then it is going, the interest applicable will be 1.5%. Alright, but the interesting point over here is the interest is not for the period of delay. The interest is from the date of deduction till the date of payment. I'll explain it to you, okay. This provision was there earlier also, but many students were not aware of this. So therefore, I'll take this as an opportunity and I'll tell you the point. Let us say tax was deducted. The date of deduction of tax was, for example, 1st of or let's say 10th of or 11th of Jan 2025. Now you're supposed to remit it by the due date of remittance. You're supposed to remit it, let us say, by the 7th of February 2025. Okay. But you actually remitted the TDS only on the 1st of March 2025. Okay. So this is the period of delay, right? But the interest is not for the period of delay. Interest will be from the date on which you deducted till the date on which you remitted. Same thing for TCS also. It will be from the date on which you collected till the date on which you remitted. It is not for the period of delay. The delays you should have remitted on 7th February, you remitted on 1st March. This is the period of delay. But for this period we don't calculate. We calculate from the date of deduction till the date of remittance. For that entire period we calculate. Okay, that remains the same. So the changes, TCS late payment, interest was 1% per month earlier. Now it has increased to 1.5%. Okay. Then comes my next amendment in section 197. Again, this amendment is applicable 1st October 2024 onwards. You must have learnt in section 197, we can apply to the assessing officer that, please don't deduct tax against my income, or please deduct tax at a lesser rate. We can get a certificate for deduction of tax at lower rate or for non-deduction of tax. Like for example, if my income is below basic exemption limit, still if somebody deducts tax against my income, unnecessary hassle for me guys. I'll have to apply to get refund because my income is anyways less than BEL, so no tax liability for me. So still if others deduct TDS, I will get refund, I will have to get unnecessary hassle. So in such cases, I can request the AO that AO please give me a certificate for nil deduction of tax or lesser deduction of tax. Now this certificate I can request for only in some sections, for all these sections. In this list, they have added section 194Q. You remember 194Q, it applies when I purchase goods from a seller more than 50 lakh rupees in a year. Their 0.1% TDS is section 194Q. So even section 194Q has been added in this list. So if 194Q tax has to be deducted against me, and if I think that I will unnecessarily result in a refund, I can request the AO to give me a certificate for lower TDS or no TDS. So what are the sections for which you can request for no TDS or lesser TDS? That list has now been amended to include even 194Q. Then coming to the last amendment in your TDS discussion, this is in TCS. In TCS, we have section 206C1F, right, where tax is collected at the rate of 1% against sale of motor vehicles if the consideration per vehicle is more than 10 lakhs. Now, section 206C1F was applicable only for motor vehicles. Now, the section has been amended, but this amendment is from 1st Jan 2025. This amendment is now saying that this section will apply not only to motor vehicles, it will also apply to other notified goods. Understanding? Basically, inside section 206C1F, we are widening the scope. We are including other notified goods, other luxury goods, the value of which is more than 10 lakhs. As of now, nothing has been notified, but in case something gets notified, it will fit under 206C1F. So 206C1F, the scope has been widened. It will include not only motor vehicles now, it will also include other notified goods, other luxury goods, the value of which is more than 10 lakhs. Okay. So this is it with your TDS and TCS discussion. In TDS, we had a change in section 192. Employee can inform the employer about TDS credit and TCS credit. Then section 193. The 10,000 limit was only for 2 bonds earlier. We're adding the floating rate savings bond as well. Then section 194 TDS will also apply to 222F. Then in 194C we learnt if 194J is applicable, then don't apply 194C. Most important TDS amendment was in 194IA. We will see the total consideration for that particular removable property. We will not see per buyer, per seller. For that particular removable property, we will see the total consideration. Then we saw in 5 sections, the TDS rate has reduced from 5% to 2%. Then we discussed if TCS is remitted to the government late, the interest rate has been increased from 1% per month to 1.5% per month. And finally, we learned you can ask for low deduction certificate for 194Q as well. And then we learned 206C1F scope has been widened. It will include not only motor vehicles now, it will include any other notified goods also, the sale value of which is more than 10 lakhs. Okay. Now coming to one last amendment now, which is in your assessment procedures chapter. In assessment procedures chapter, remember I taught you about 139AA, where we have to give our Aadhaar number in every application form for PAN and also in the ITR. In both the places we are supposed to give our Aadhaar number, and if you are not able to get, if you don't have an Aadhaar number, it's okay. Go apply for Aadhaar. When you apply for Aadhaar, you will get a 28-digit enrollment ID. You put the enrollment ID. This is how we used to learn. But now the government is saying enough is enough, no more enrollment ID concept. You have to get Aadhaar number and put that Aadhaar number in your PAN application and in your ITR. You don't have the option of giving enrollment ID anymore. Also, earlier, if you got a PAN on the basis of enrollment ID, now after all these days, by now you should have gotten your Aadhaar number. So you have to inform your Aadhaar number to the government by a notified date. The date is not notified till now. I'll explain it once again. Earlier in the PAN application, if you want a PAN number, you will fill application form, no? And also in your income tax return which you file, in both you have to quote your Aadhaar number. If you don't have Aadhaar number, it's okay. Go apply for Aadhaar. If you apply for Aadhaar, you will get a 28-digit enrollment ID. You give your enrollment ID. This was a provision. But now if you see, in PAN application and in ITR, you have to put Aadhaar only. You can't put enrollment ID. So get Aadhaar number and ensure you put it over here. But before this provision, earlier people might have given in PAN application enrollment ID, guys. Before this amendment happened, many people, to get PAN number in application form, they would have given enrollment ID. So government is saying, now you have given enrollment ID means what? It means you had applied for Aadhaar. So by now you should have received your Aadhaar number. So don't let the government have only your enrollment ID. You inform the government that what is your Aadhaar number. Understanding? Earlier you did not have Aadhaar number. So you put enrollment ID in PAN application and we accepted it. Now after all these days, Aadhaar number would have come for you. So you inform the government what was the Aadhaar number by a certain date. What is the date? They have not notified till now. So there are two amendments over here if you notice carefully. Number one, anymore you cannot quote your enrollment ID over here. Over here you have to quote only your Aadhaar number. Amendment number 2, earlier in the PAN application, if you have given enrollment ID, it means what? It means you had applied for Aadhaar. You got enrollment ID number, that number you put over here. Now after all these days, Aadhaar number government would have allocated to you. So whatever Aadhaar number is allocated to you, inform the income tax department. Okay, so that is it guys with all your amendments with examples. Discussion is over. The capital gains chapter is the only chapter where there are slightly complicated amendments. If you watch it carefully, patiently, I'm sure you would have understood. Now I request you to ensure that you have a look at the PDF as well. I will share the PDF in my Telegram channel. You can download it from there. I have made it printable so that you can print it and refer to it at your convenience. Alright, and please ensure you let me know in the comment section if this has benefited you, because I've tried my best to simplify the amendments for you as much as possible. Alright, thank you guys. I think it was a very productive session. I am pretty content with how the whole session went. If it benefited you, ensure you let me know. Thank you. Bye-bye.